So just as we discussed, our plan for today is conceptual revision. We will revise everything in financial reporting, but not in detail. It's an overall recap. We have so many IFRS and IAS standards in financial reporting. We will cover each and every standards. What are the main rules and what are the accounting treatments? Okay, then we will be covering consolidation, that is group accounts. What happens if two or more companies come together? What happens if there is an acquisition? We will complete each and every rules regarding consolidation. And we have interpretation, how to interpret these statements. These are the core topics of financial reporting. Everything we will be covering today. And tomorrow we will be practicing essay questions for 20 marks, C-part questions. And I'll teach you how to make use of the My ACCA platform. Okay. So before starting, can anybody tell me what is the objective of financial reporting? You might have watched recordings or you might have had your own live classes to help investors make decision. That is one point. Very good. Any other points? Why do you need financial reporting? What is the actual objective of learning this subject? Anything else? To help management take decisions. Yes. Yes. You're all correct. You're all correct. You're into the final part. Pash, Saumya, both of you are discussing about the decision-making part. Yes. You can write so many points, but before that, your ultimate objective of financial reporting is to understand how to deliver this. Okay, decision-making is an objective for users. Very good. For users to help them make decisions, whether it's investors. For investors, they will be making use of these financial statements for their investment decisions. For businesses, for their managers, they will be making managerial decisions. Okay. Yes, to know company's financial position. Very good. So, in short, you can say that your objective is to prepare financial statements. To prepare financial statements. Okay. And this financial statement will help you to make the decisions. Okay. Your final point, you are very correct. For the users or the stakeholders, they need to make financial decisions. And what will help you to make these decisions? Financial reports or financial statements. So our objective of learning financial reporting, of learning this subject, is to prepare financial statements. How can you prepare financial statement? What are the rules and regulations? What are the accounting principles? All those things we will be learning in financial reporting. And throughout this subject, you will be thinking from the perspective of a senior accountant. Okay, why am I calling you senior? Why can't we be junior accountants? The junior accountants, what they will do is the initial recording. That is, if a transaction occurs, they will be initially recording it in the form of journal entries. That is the first step in accounting. Secondly, you will be posting these records from the journal entry to the ledger. Okay. Somebody is unmute. 1 second. Yes. So, some noise. Yeah. So my point here is, initially, the junior accountants will be doing the bookkeeping part. They will be recording the journal entries. They will be posting to ledger accounts. And from the ledger account, they will be preparing trial balance. Now, we are the seniors. Okay, seniors. The senior accountants will go to the final step in accounting, that is statement preparation. The final step in accounting, which is FS preparation. Okay, there are 4 steps in accounting. First step is recording in the form of journal entry. Second step is preparing ledger accounts, posting to ledger accounts. Third step is preparing trial balance using the final closing values from ledger accounts. From the ledger account, you'll be preparing trial balance. That is the third step. And the fourth and the final step is preparation of financial statements. Okay, so this final step, this last step is for us seniors. So we are learning basically about the last step in accounting. And after this preparation, we need to understand how to analyze these statements. How can we make decisions based on these statements? Okay, so we can say the ultimate objective of learning financial reporting is to prepare financial statements and analyze these statements to help the users in decision making. Okay, that is the objective. And we need to think from the point of view, from the perspective of senior accountants, where you are only making, where you are only required to do the final step in accounting. Okay, we are ACCA students. What is the full form of ACCA? There are still some people who don't know the full form. Anybody?
Association of Chartered Certified Accountants.
Very good. Association of Chartered Certified Accountants. So we have the term accountants. And you know what? This subject that we are learning, that is financial reporting, this is a core portion of accounting. Okay, in other subjects, that is financial management, performance management, auditing, all those are different streams. But as an ACCA student, we can say that financial reporting is the core, and you have so many connective subjects from financial reporting. So this is a connection, this is a link to many other subjects in ACCA. Okay, we have 13 papers in ACCA, and I can confidently say that financial reporting is a bridge for ACCA papers. So I need you to understand each and every concept in financial reporting and make sure that you crack this June session ACCA FR exam. Okay, so let's move to our topics. Your first topic is conceptual and regulatory framework for financial reporting. We have a structure, a basic structure for financial reporting. Who are the dealers? Who are the members who makes the decision? What is the financial reporting standards? Okay, what are IFRS standards? What are the rules and regulations? Okay, all those things. There need to be someone who laid down these rules, isn't it? So the board or the committee who is laying down these rules and regulations, we call it the regulatory framework. And there are certain conceptual things that you need to understand, and that is conceptual framework. This conceptual framework is a guide which helps you understand the rules and regulations and principles of accounting. So what is conceptual framework? Conceptual framework is a guide. It is a book. Let's assume like that. It is a guide that has all accounting concepts, rules, and principles, which helps you to decide what to do in a particular situation. Okay, you are trapped in a situation in a company. You had a transaction. In this transaction, what is the rule that you have to apply? So this conceptual framework will help you to make decisions because it contains all rules and regulations and principles of accounting. And what about regulatory framework? Regulatory framework includes a framework or a board, like what? A group of people, a group of bodies who frames these accounting principles and accounting standards, all those things. So we will understand what is the elements of conceptual framework and who all are there in the regulatory framework, the decision makers, okay, the ultimate body for preparing the IFRS standards and for making the like what final decisions regarding the accounting treatments that we are learning. Okay, the globally recognized standards, who are behind that? That is the regulatory framework. The regulatory framework is simply a body who lays down these regulations, rules and regulations based on accounting. And conceptual framework is the book. It is a guide that helps you to refer all rules and regulations regarding accounting standards. So when it comes to financial reporting examination, I can say that this is the least tested part. In FR, you have so many things to learn, and this conceptual and regulatory framework part, this is least tested. A maximum of 4 marks you can expect out of 100 marks exam. A maximum of 4 marks can be expected from conceptual and regulatory framework. The remaining will be tested from standards. We need to learn each and every standard in detail. So from the standards, you will be tested for your exam, and from consolidation you can expect high marks, and from interpretation also you can expect high marks. But this portion we need to cover this portion because we need to understand who is behind the accounting rules and regulations. Okay, who is behind the preparation of IFRS standards. So just for your understanding, I have this topic here, but for exam point of view, this is comparatively least relevant topic. And in your plan, if you need a reference, the reference will be chapter number 6 and 7. Let's go through these. Okay, let's see who all are there in the regulatory framework. We have 4 members in the regulatory framework. They are a group. The regulatory framework is a group of people. Let's say people in the sense we have 4 bodies here. The regulatory framework is a group which have 4 people. First one is IFRS Foundation. The second person is IASB. The third person is IFRS Interpretations Committee. And the fourth one is IFRS Advisory Council. 4 of them combine their knowledge and their working together to form this framework, regulatory framework. So let's discuss in brief what are the objectives, what are the ultimate aims of all these people. The first body is IFRS Foundation. The foundation is the supervisory body of for the IASB and is responsible for governance issues and ensuring each member body is properly funded. So there are 2 main objectives for IFRS Foundation. The first objective is it is the supervisory body. So among 4 of them, the supervisor is IFRS Foundation. This is the superior body. So we can say among all 4 bodies in the regulatory framework, IFRS Foundation is superior. And one of the main objectives of IFRS Foundation is ensuring proper funding. Okay, so these are the 2 main objectives of IFRS Foundation. Okay, IFRS Foundation is the superior body among all these 4 bodies. IFRS Foundation is superior, and its objective is to ensure that proper funding is happening between for IFRS Interpretations Committee or IFRS Advisory Council for their working, what all fund they require, that is necessarily available. To ensure this, you have the IFRS Foundation. Then the second one is International Accounting Standards Board, IASB. IASB is the main body who is responsible for preparing the standards that we are going to learn in FR. So the board is the independent standard setting body of the foundation. Its members are responsible for the development and publication of IFRS standards and interpretations developed by the Interpretations Committee. So the IASB will take help from the Interpretations Committee, and they will be making standards, whatever the Interpretations Committee have interpreted. We'll discuss the objective of Interpretations Committee also. So whatever the Interpretations Committee has as a concern, IASB will be solving this concern. Whatever issue is raised by the Interpretations Committee, IASB will have a solution for this issue in the form of international accounting standards, international financial reporting standards. Okay, so IASB is the one who provides solution for all accounting issues. For whatever accounting issues that a company is currently facing, IASB will be giving a solution in the form of international financial reporting standards. So the Interpretations Committee, what will be its role? The committee will be responsible for providing the understanding the issues that companies are facing. The IFRIC reviews widespread accounting issues on a timely basis and provides authoritative guidance on these issues. So their objective, the Interpretations Committee's objective is to interpret the accounting treatments, the existing accounting treatments and the current issues that companies are facing based on accounting. So these issues, the Interpretations Committee will be identifying the issues that are faced by the accounting firms or companies, and they will report these issues to the foundation and the IASB. So IASB will consider all these issues and they will prepare IFRS standards Okay, they will prepare IFRS standards as a solution to each and every issue raised by interpretation committee. And that's how the regulatory framework works. Now we have one more person in this group, that is IFRS Advisory Council. As the name suggests, its role is to provide advice to all other members. The council is the formal advisory body to the board and the foundation, to IASB and the IFRS Foundation. The advisory council, the advisory body will be giving advice. So whatever decision IASB or IFRS Foundation is making, it will be with respect to the advice given by the advisory council. So in the regulatory framework group, there are 4 members: IFRS Foundation, who is the superior body and ensures the proper funding to other bodies in the group. Then we have IASB, that is the independent standard setting body. IASB gives solution to each and every accounting issues. And who will identify these issues? The IFRS Interpretations Committee is responsible for identifying each and every issues faced by a firm or a company. Then we have one more person, that is IFRS Advisory Council. And this Advisory Council provides advices for IFRS Foundation and IASB for making decisions and for preparing standards. Okay, so understand the role, the ultimate objective of each 4 of these members, and all of them together forms the regulatory framework. Okay, so this simple understanding based on each and every member is enough. You don't need any in-depth understanding about IFRS Foundation, IASB, Interpretations Committee, or Advisory Council. Just understand their basic objective. Okay, so I hope this part is clear. What is the regulatory framework? Who are the members in the regulatory framework? What is the basic objective of all these members? Okay, this is the regulatory framework. And when you are preparing IFRS standard, who is responsible for preparing IFRS standard? IASB. IASB is responsible for preparing IFRS standards. So what is the procedure for preparing IFRS standards? Firstly, the board identifies a subject and appoint advisory committee to advise on the issue. We know who is advisory committee. So the advisory committee will take the first step. The interpretations committee will take the first step, and they will ask the advisory committee to provide advice. So the board identifies a subject and appoints advisory committee to advise on the issue. Now, the second step is the board also publish a discussion paper for the public comment. So initially, before making the final decision, the board, the IASB, will be publishing a discussion paper for public comment. Then the third step is the board publishes exposure draft. Board publishes exposure draft for public comment, being a sample version. The after discussion paper, the third step is to prepare exposure draft, and finally the board publishes the final text for IFRS standard. So it's not like they will make their own decision without discussing with anybody. Okay, it's the ultimate decision is made by IASB, but still IASB is taking the help from advisory committee and the public to make the final decision. Before framing a standard, IASB take the advice from advisory committee and from the public through discussion paper and exposure draft. Okay, so these are the 4 steps for preparing international financial reporting standards. Step 1, take advice from advisory committee based on an issue. Step 2, publish discussion paper. Step 3, prepare exposure draft. And step 4, the final draft is prepared and published. Got it? These are the steps in preparation of IFRS standards. Now, just as we discussed, what is the objective of preparing these IFRS standards and what is the objective of financial reporting? The objective of financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. So, in short, we have already discussed what is the objective of financial reporting. It is to prepare financial statements and to prepare financial statements in a way that is understandable to the stakeholders. The stakeholders includes investors, lenders, creditors, suppliers, then management, government, employees, everyone. So for all these stakeholders, we need to make financial statements that is understandable and in a manner that it helps each of them to make their own decisions, investing decisions, managerial decisions, or whatever decisions. Okay, so the ultimate objective of financial reporting is preparing financial statements to help the stakeholders to make decisions. Okay, to help stakeholders to make financial decisions. That is the objective. Now, for whatever financial statements we are preparing, we have certain qualitative characteristics. Okay, these are the qualitative characteristics of financial reporting, and this is an important topic. Okay, this is a very important topic. We have two classifications for qualitative characteristics. The first one is fundamental qualitative characteristic, and the second one is enhancing characteristics. You can say fundamental and enhancing. Fundamental qualitative characteristics and enhancing qualitative characteristics. So whatever is discussed in this class, it is basically only theoretical. For examination, you can expect a 60% problematic questions and remaining 40% for theory, for explanation. But here in today's class, we are going to the conceptual aspect, for the theoretical aspect. So when we are preparing statements, okay, your objective, your ultimate objective is preparing statements, isn't it? So when you are preparing statement, you need to make sure that certain qualitative characteristics are met. Quantitative aspects we will be discussing, that is the major portion in financial reporting. And there is also a minor portion, which is the theoretical part, the qualitative part, qualitative characteristics. The first qualitative characteristics, first classification of qualitative characteristic is fundamental qualitative characteristic. There are two fundamental characteristics. The first one is relevance and second one is faithful representation. Fundamental qualitative characteristics are relevance and faithful representation. Let's discuss in detail what is relevance and what is faithful representation. The information given in the financial statement is relevant only if it is it has the ability to influence the economic decision of users. We need not include all unnecessary information in the statement. Okay, if you are preparing a statement, only the relevant information, only the information that can influence the economic decision of users need to be included. That is the first point. To say that an information is relevant, it must be, this piece of information must have the ability to influence the economic decision of users. Then only we can say that this information is relevant and it must be included in the statement. So any irrelevant information, we can say any immaterial information. Sometimes for a big company, you will have stationary purchases. It is not necessary that you need to include this stationary purchase expense in your statement because it is very immaterial compared to other transactions happening in the company. So only relevant information need to be included in the statement. This is one of the fundamental or basic. Fundamental, the term meaning is basic. This is one of the basic characteristic of financial reporting statements. Then we must ensure that it is provided on time to influence the decisions. So available on time. This is also a factor that represents relevance. Okay, if the information is not available on time, then it's of no use for decision making. You are making the decision today, and this information is outdated. Okay, you are getting a piece of information that is related to previous year. In that case, this is of no use, isn't it? So to be relevant, we have two conditions. The first one is this piece of information must have the ability to influence the economic decision of users. That is, it must be material in nature. And there is one more factor affecting the concept of relevance, which is the information must be available on time. It must not be outdated. Okay, it must not be outdated. We can say the first condition for relevance is for economic decision making, it must be material. Only material items are included within the statement. And it must be updated. Okay, we can say not outdated. Outdated information will not be included in the statement. Okay, so that's about the relevance. Now we have one more fundamental characteristic, that is faithful representation. Every piece of information given in the statement must be faithfully. Okay,
डोक्याची
faithfully,
बॉटल दे ना.
honestly presented. Can you please mute? Okay. So the second fundamental characteristic is faithful representation. And what is faithful representation? The information must be accounted for and presented in accordance with their substance and economic reality and not merely in their legal form. We have one important accounting concept, that is substance over legal form. All these accounting concepts, materiality concept, then substance over legal form concept, accruals concept, prudence concept, all these concepts you might have learned in your basic accounting in when you were learning F3 financial accounting, or in your degree program, or in your +1 +2, whatever, you would have analyzed, you would have understood the meaning of all these accounting concepts. Okay, in financial reporting, we are applying these concepts and we are preparing the statements. So, this based on substance over legal form concept, we have a basic qualitative characteristic known as faithful representation. And under faithful representation itself, we have three subdivisions. When can we say that this information is faithfully represented? Okay, the first characteristic under faithful representation is completeness. The information given within the statement must be complete. We will not be recording any incomplete piece of information that is not understandable to the users. So, completeness means it must contain all necessary descriptions and explanations. Okay. Maybe if we are just giving the value of asset is equal to 1 million, you will not understand how this 1 million came, where did this came from. Okay, so whatever is the information regarding the how you got the value 1 million, the calculation for the policies that you have chosen, all those things, all those explanation must be provided as part of faithful representation. Then another characteristic is neutrality. Neutral means the information must be like what? It must not be influenced by any other person. Okay, it must be neutrally provided. Then we have one more characteristic, that is free from errors and bias. Free from errors and bias means like there must not be any notable omissions or errors happening. It must be cross-checked, cross-verified, because this is an important piece of information for all users or stakeholders to make their decisions. Okay, where to invest, how to frame the next policy or strategy. All those decision making is based on this statement, isn't it? To understand the importance of the statement, it must not have any errors or bias. Then it must be neutral. It cannot, I mean, this statement, it must not be influenced by any other person. Okay, even for the management, they should not be able to influence whatever values are given. It must be based on certain rules and regulations. So, completeness, neutrality, and free from errors and bias. If all these three concepts are ensured, then we can say that this statement is faithfully represented. And for relevance, we had two steps, two factors representing that a piece of information is relevant. That is, the information must be material and it must not be outdated. So these are the basic characteristics or the fundamental characteristics of financial statements. Okay. Now we have some additional sub characteristics. We can say enhancing qualitative characteristics. There are four enhancing qualitative characteristics. First one is comparability, then verifiability, timeliness, and understandability. In addition to relevance and faithful representation, these are the secondary characteristics or enhancing characteristics. The first one is comparability, first enhancing characteristic. The users must be able to compare the financial statement of an entity over time to identify trends in financial position and performance, and must be able to compare the financial statements of different entities to evaluate their relative financial performance and financial position. So you can make two types of comparisons. Comparison between previous year's statements, your own company's previous year's statement. And comparison between competitor companies. Okay. So you can make comparison. You once you prepare the statement, you can compare your statement with your competitor company. and you can analyze where we went wrong when we are comparing with the other company. Are we on a better position? We can understand the financial position and the profitability. And if you can see that the other person is more profitable, then go through their statements. Okay, see what policy they have implemented, what is their strategy, and if it's okay, you can implement their strategy in our company, and we can also be more profitable. So comparability is an important condition for a statement, a financial statement. Then we can also compare with our own previous year statement and analyze the trend, whether our company is moving to a growth, or whether our company is having a downfall. All those things we can analyze. Then, for the purpose of comparison, we have two accounting concepts here, that is consistency concepts, and we need to disclose everything. Then only we can compare, isn't it? Only in financial data is provided means you cannot make it available for comparison. Yes, Ashwat, this class will be uploaded in YouTube, or it might be provided with you in LMS. Okay, we are planning to upload it in the YouTube itself. Yes. Okay, so here we were discussing about the enhancing qualitative characteristic. We have four enhancing qualitative characteristics, and the first one is comparability. We can compare our financial statement between our own previous year statement and current year statement, and we can make comparison between our company and another competitor company. So for comparability, you have two accounting concepts behind it. We have consistency, that is every information, every rule that you are following, it must be consistent. You cannot change your policies every year, then it will not be consistent. Okay, you cannot change the format of the statement that you are preparing. Okay, initially you followed one format, and in the current year you are following a different format to prepare your statement. That is not possible, because this will be breaching the consistency concept. Consistency means what? You must have a regular format and a regular policy. Okay, there can be a policy change, and we will discuss it in IAS 8. Okay, when can you have a policy change? It's not like whenever your company want, you can have a policy change. It's not like that. Policy change is permitted only in specific situations. Okay, so unless there is a necessity, your statement must be consistent. It must be in a regular format to facilitate comparison. Okay, so comparison is an enhancing characteristic of your statement. The next one is verifiability. Financial statements verification can be direct or indirect. You can verify directly or indirectly. Then, what is direct verification and indirect verification? Direct verification means verifying on an account or other representation through direct observation. For example, by counting cash. Okay, you're directly counting cash and you are verifying the amount given in the statement. That is direct verification. But there are certain circumstances where this direct verification is not possible. You cannot sit and count cash. There will be huge amounts and huge, uh, like asset values, liability values, equity values. Those values cannot be counted with cash. So you follow indirect verification means. What is indirect method? You have certain models and you have certain calculation methods to ascertain the values. So indirect verification means taking the inputs into a model, formula or other technique and recalculating the outputs using the same methodology. So using whatever methodology you have calculated this figure, let's say for example, depreciation. If you have calculated depreciation using straight line method, then for verifying this, you have to follow straight line method itself and recalculate it. Okay, you cannot count cash and ascertain the amount of depreciation, isn't it? So we have indirect method and direct method. Direct method is where you sit and count cash. Okay, directly you are verifying the amount given in the statement. And indirect method is where you follow a particular format or you follow a particular method and you recalculate the value using the same method and make sure that the information given in the statement is correct or accurate. Accuracy is a very important condition to be maintained for a financial statement because it is used by users for their decision making. Then we have another enhancing characteristic, that is timeliness. We already discussed that in case of relevance, which is our basic characteristic, to be relevant, for a piece of information to be relevant, it must be available on time. And here also we are stressing that sentence itself, timeliness. Timeliness means having information available to decision makers in time to be capable of influencing their decision. Okay, so timeliness, you can include this factor both as a basic condition, basic characteristic, and an enhancing characteristic. Okay, so timeliness means every piece of information included within the statement must be updated. It must be up to date. No outdated information will be given in the statement. And the final characteristic is understandability. Financial information should be understandable to the users, and it depends upon the way in which the information is presented and the capabilities of the users. So, when you are preparing financial statement, you are assuming that all users of this financial statement is having reasonable knowledge, reasonable understanding about accounting principles and rules. Okay, maybe usually all employees or all public will not have the knowledge of accounting and economic principles. But when you are telling that this is helping the users to make decisions, we are assuming that all these users, all these stakeholders have sufficient knowledge based on accounting and economic rules, economic accounting principles. Okay, so that is understandability. With this four criteria, making sure that all these criteria, all these characteristics are incorporated within the statement, we will be preparing statements. Okay, we have two basic characteristics, that is relevance and faithful representation, and we have four enhancing characteristics, that is comparability, verifiability, timeliness, and understandability. So these are all characteristics incorporated within a statement. Okay, these are usually tested for 2 marks to make sure that you understand the concepts. Now we have elements of financial statements. We have already discussed the characteristics of financial statements. Now let's see what all are included in a statement. We have 5 elements of financial statements, that is asset, liability, equity, income, and expense. Okay, so these assets means what? I think you'll already be familiar with all these termings, but we have definitions laid down by IASB. That's why you have to go through this. These are definitions by IASB. You have to understand the definition laid down by IASB because in a 2 mark MCQ question, they can give you 4 options and you need to choose which among the following is correct. Maybe every sentence seems similar. You feel like this each and every sentence is a definition for asset. You know what is asset. You know the meaning of asset, but that is not enough. You need to understand what is the definition laid down by the IASB. So as per IASB, asset is the present economic resource controlled by the entity as a result of past event. That's it. Just a simple definition. You can split it into three. We have a present economic resource. That is, the asset is a resource for the company. Then it is controlled by the company, and this asset is controlled as a result of a past event. Okay, maybe through purchase or maybe through like what acquisition. So this is an asset is an economic resource controlled by an entity as a result of past event. And you need to understand the definition of liability. Present obligation of the entity to transfer an economic resource as a result of past event. You have equity. Equity is the residual interest in assets of the entity after deducting all liabilities. So what does the sentence mean? Anybody, can you tell me the basic accounting equation? Basic accounting equation. Prashant, can you please stop doing this on the screen? Yes, yes, very good, very good. So all of you know what is the basic accounting equation. Total asset equal to total equity plus liability. So I can say that from this definition, residual interest in the asset of an entity. Why is that given like that? Equity. From this basic equation, you can see asset equal to equity plus liability. Now, can you rearrange this equation? Equity equal to what will be equity? Just rearrange the equation. Very good. Equity is equal to asset minus liability. Total asset minus liability. So that is the definition of equity. The residual interest in asset, whatever is remaining in the asset after deducting the liability, that is known as equity. So what they have did, what IASB have did is they simply rearranged the basic accounting equation and framed a sentence. Residual interest in asset of an entity after deducting all liabilities, which means equity is equal to asset minus liability. That is the definition given by IASB for equity. Then we have two more elements, income and expense. Increase in assets, decrease in liability, and increase in equity other than contributions from shareholders. That is the definition given to income. We all know what is income. Okay, anything that is generated as a revenue from the company for a company, that is known as income, isn't it? Anything that leads to an inflow, that is income. But we cannot give our own definition because IASB has already provided a definition for income and expense. So these are the definitions for income and expense that IASB has given. And what is expense? It is decrease in asset, increase in liability, or decrease in equity other than distribution to shareholders. So you need to go through these definitions and make sure that when you get an MCQ question, you will be grabbing those 3 marks in seconds. Okay, you will not be sitting and thinking in the exam hall, oh, what was the definition of asset? Okay, it's just simple definition. Just go through this definition, but you have to go through this definition. You will not be ignoring it because in my exam, when I was writing 5 years ago, when I was writing my exam, I had this thing. Okay, the definition of liability, as per IASB. Okay, and I was confused. I know what is liability, but I actually don't know the definition laid down by IASB. Okay, so make sure that you go through these definitions, even if you know what is asset, liability, equity, income, and expense. Okay, now measurement basis. As per the conceptual framework, we have 4 measurement bases. How to measure assets and liabilities. We can use any of the 4 values in a particular situation given. The first one is historical cost. If somebody is asking you, what is the value of this asset? Then ask him, what value do you want? Do you want the historical cost, or do you want to know the current cost, or fair value, or do you want to know the value in use? So all these figures represent the value of an asset. But all these values will be different. We need to understand what is historical cost, what is current cost, what is the fair value, and what is value in use. See, historical cost is the actual amount of cash paid or consideration given to the item. Historic cost means the purchase cost. Okay, when you are buying an asset, here I'm taking asset as an example, but measurement basis is also for liabilities. Keep in your mind, this for theory part. So if you have an asset, for example, you have a machinery, and you bought this machinery for 1 million. So whatever is the money that you have spent for acquiring this asset, that is the historical cost. Machinery, 1 million, purchase cost. The purchase cost, whatever consideration you have provided when you bought this asset, that is known as historical cost. Now for the same machinery, what is the current cost? Okay, let's say you bought this machinery for a brand. The brand name is Y. Just an example, you have a brand called Y, and with this brand you bought an asset, and when you bought this asset, you gave 1 million as consideration. Now, what is the current cost? The cash that would be paid to replace the asset at current value. You might have bought this asset 2 years ago. Now, today, if you are going to the market and you are buying this brand Y's machinery, in that case, the value might have increased or the cost might have decreased, isn't it? Usually we have in the market, we have inflation and we have demand and supply. Based on all these things, the price is fixed. So for the same type of machinery, when you go to the market today, what is the value? What is the cost for this asset? So now, today, purchase might have happened few years ago or few months ago. So whatever happened, whatever is the money that you gave, that is the purchase price. Current cost is today's cost of same machinery in the market. It may be now the market has like what very it has a very big demand, very huge demand in the market. So its value is now 1.5 million. Okay, you got this asset for 1 million. Now, if you want the same asset, you're planning to buy the same asset for the second time. In that case, your current cost will be 1.2 million. Okay, whatever is the current market value. Now you have fair value. Always what happens is students get confused with current cost and fair value. Fair value is what you can get for your asset, your current asset. You have this machinery that you bought for 1 million. And today, if you are planning to sell this asset, what is the value that market is ready to give you? Fair value is the current market price at disposal. So understand the difference between current cost and fair value. Current cost is the cost of the asset. If you are going to the market to purchase the same asset, then what is the cost of this asset? What is the price that you will be giving to the market? Okay, to the supplier. But when it comes to fair value is the value of this machinery, value of asset in active market, and this includes the value of asset in its present condition and location. Okay, so maybe you bought this asset 2 years ago. You have used this asset a lot, and now it has its value has declined. Okay, this machinery has been in your office, in your building for like 2 years, and these 2 years you were using this machinery continuously. And now today, if you are selling this asset, if you are selling this machinery, nobody will be giving you 1 million, isn't it? So whatever is the reduced value, whatever is the value of this asset in the active market, whatever uh, the market is ready to give me for this machinery in its present condition at this present location, that is the fair value. Now you have one more thing, that is value in use. It is the discounted value of future cash flows. You know that asset, it represents the like what, economic resource of a company. So from this asset, from this resource, whatever is the inflow that you can expect in the future, maybe this asset has a useful life of 10 years. And in this 10-year time, uh, based on the like what, latest information available, you will be making some predictions. Every year you can get 50,000 from this asset. Okay. Every year there will be an inflow of 50,000 from this asset. In that case, you will be calculating the present value of all these future outflows. So this value in use is the present value of all future inflows from the asset. You bought an asset with an objective to earn money, isn't it? You are expecting inflow from this asset. So whatever inflow that you are expecting from this asset, you will be taking the present value of all these assets. Okay, I hope you know what is present value. Do you know what is present value? In financial reporting, you will come across this term eventually. Okay, what is PV? Present value. Can you give me an equation for calculating present value? Sometimes, for example, in your question, they will be giving you a value. This payment is to be made after 2 years, or this receipt, you will be getting this inflow after 2 years or 3 years. In that case, you need to consider the concept of time value of money. Time value of money means the value of money diminishes over time. When you're moving forward, the value of your money will be declining. Based on this concept, whatever is the future value given in the question, you have to calculate today's value, that is present value. Very good, Ashyat. Uh, future value into discount factor. Exactly. Present value equal to future value into discount factor. You need to know what is discount factor. Discount factor is equal to, you have an equation. That is 1 divided by 1 plus r raised to n. Exactly. Great. Perfect. Good. 1 by 1 plus r raised to n. So this present value concept, there are so many instances in financial reporting where you have to calculate present value of inflows and outflows. Okay, whenever there is a value given in your question, that is like you have to make payment on a future date or you will receive some money on a future date. At that time itself, this present value concept needs to be there in your mind. Okay, present value only will be recorded in the statement. You are preparing the statement today. So in today's statement, you cannot include a future value. So whatever is the future inflow or outflow, you will be calculating present value of that amount. That is by applying this equation, future value into discount factor. For the calculating present value, relevant information will be given in your question. R means the rate of interest, prevailing, the rate of prevailing interest. Then you have N. N means the number of years. If you are calculating the present value of a future value after 2 years, for example, you have a receipt after 2 years means your N will be 2. If you have a receipt of 5 million after 10 years means then N, the number of years will be 10. So N means number of years, R is the prevailing rate of interest. When you apply this to the equation, you will get the discount factor, and always discount factor will be a 0.xyz figure. Okay, so you will be multiplying the future value with this discount factor, then you can get your present value. Okay, so here my point of present value is when somebody is asking you what is the value of your assets. Okay, what is the value of your asset means you can say my asset has a value of this much, where it is a value in use, where you are expecting 5 million as an inflow on future date. So calculate the present value of this 5 million, and whatever is the present value, that can be called as the value of your asset. So you have 5 values with respect to assets. The first one is historical cost, that is on if somebody is asking you what is the value of your asset, if you want you can tell that the value of my asset is 1 million, I bought it for 1 million. And if you want you can tell current cost, the value of my asset is 1.5 million. In the market today, if you go and ask the value of this asset, it will be 1.5 million. Then if you want you can tell the fair value. Fair value means when you are ready to sell this asset in its present condition in this current location, what is the value that market is ready to give you, okay, in this present condition. Okay, that is a fair value. So you can tell that my asset has such and such value, the market is ready to give me this value. Then, or if you want you can tell my asset has the value in use of this much. Okay, will direct cost attributable be included in this? Yes, of course, every direct cost attributable to the purchase will be included here. Okay, every direct cost means Harsh, please don't draw on the screen. Everybody can see. Okay, so this historical cost, it includes every direct cost related to purchase. We'll see what are the direct costs related to purchase. Includes every direct cost of purchase. Not only purchase, whatever is the direct cost that you incurred in order to bring this asset to its present location and condition, every cost, whether it is subsequent or initial, it can be included in the historical cost. Sorry, not subsequent. I mean this subsequent in the sense until the date of installation. Okay, until the date it is ready for use. So whatever is the direct expense that you have incurred based on this purchase, you can include it in the historic cost. Any doubts? Any other doubts regarding what is historic cost, current cost, fair value, and value in use? So these are the measurement basis for all assets and liabilities. You can expect question for like what? Only theory questions, 2 more questions from this part. Usually calculation questions are not, will not be coming from this part. Okay. That's all about the basics, the conceptual and regulatory framework. Who all are the members of the regulatory framework? How do you frame IFRS standard? Then, what is the objective of financial reporting? When you are preparing statements, what are the qualitative characteristics? What are fundamental characteristics? what are the enhancing characteristics, what are the elements of financial statements, and what are the measurement basis. These are the important things that you need to understand from chapter number 6 and 7 based on conceptual and regulatory framework. Okay, got it? Yes, good. Now we will see standards one by one. So before going into the standards, you have to have the picture of all statements. What are the financial statements? Now we already discussed that our objective is preparing financial statements. So isn't it important that you know the format of these statements? So as per IAS 1, which is laid down by our IASB, International Accounting Standards Board, we have IAS 1, that is presentation of financial statements. There are 5 financial statements, and each of them has a predetermined format that you need to keep. Okay, even if there is a slight change, it is not not a big issue. But you have a basic structure, a basic format laid down by IASB as per IAS 1. The first statement is statement of financial position. We can call it SOFP. SOFP. That is the most important statement which helps you to analyze the financial position of a company. Then you have statement of profit or loss and other comprehensive income, or statement of profit or loss plus a statement showing other comprehensive income. Why is it given like this in separate manner? It is just to show that you have a choice. Okay, if you want, you can prepare SOPL plus OCI in one statement itself. You can do both. Okay, give the main heading, statement of profit or loss, and afterwards, when you calculate the profit or loss, then in the same statement itself, give a subheading, other comprehensive income. Okay, otherwise, you have an option to do separately, to prepare these statements separately. That is, in one paper, you are calculating the profit or loss, and in another paper, you are calculating the other comprehensive income. But in our examination, in financial reporting, you only need to go through this first one, SOPL and OCI. Okay, we are not preparing the statement separately. We are preparing statement of profit or loss and other comprehensive income in a combined statement. Okay, so the second statement is SOPL and OCI. Then you have statement of changes in equity, that is SOCIE. And you have statement of cash flows, that is SOCF. And finally, you have disclosure notes or explanatory notes, which does not have a proper format. Disclosure notes. Okay. So that's it. These are the 5 statements that, as a senior accountant, that we are obliged to prepare. Okay. Our objective is to prepare the statements, and there are 5 statements that you need to prepare. We need to understand the preparation of all these statements. But for your examination, they will be testing only preparation of SOFP, SOPL and OCI, and very rarely SOCF. They will not be asking you to prepare statement of changes in equity or the disclosure notes. Okay, so these are the 3 important statements that you need to understand. And yes, that's it. So as per IAS 1, we have a particular format for each of these statements. Let's go through these formats. Pro forma for statement of financial position. This is the pro forma for SOFP. You have 3 main headings here. No, we have 2 main headings. The first one is asset. First main heading is asset. And the second main heading is equity and liability. Okay, so these are the 2 main headings of statement of financial position. SOCIE is not that important, and in your examination, they will not be asking you to prepare the statement. But you need to understand what are the workings happening inside SOCIE, what are the elements of statement of changes in equity, and what all additions will happen, what all deductions can happen. Just understand, but it is like what? Its preparation will not be tested. Got it, Harsh? Yes. So here, the first statement that we are looking into is statement of financial position. In statement of financial position, you will be considering three important elements of SOF, your statement. Your financial statement has 5 elements, that is asset, liability, equity, income, and expense. So the first 3 elements, asset, liability, and equity, these 3 items will be included in your statement of financial position. And the remaining 2, that is income and expense, those elements are included within your statement of profit or loss, your next statement. So these 5 elements, these are incorporated within 2 different statements. The first one is SOFP, and you are preparing SOFP as at a particular date. You note this as at 31st December. It may not always be 31st December. Whatever is the year end, on that date, you will be looking what all assets are there in your company, what all liabilities are there in your company. Okay, what is the equity position of your company? So, as on a particular date, what is the total of your asset, what is the total equity, and what is the total liability? You need to match the account, you need to prove the accounting equation here. Okay, you already know what is the accounting equation, that is asset equal to equity plus liability. So you are proving the accounting equation based on this statement, okay, through this statement. And you can classify your asset as non-current asset and current asset. In the non-current asset, you have property, plant and equipment, investment, and intangibles. Now let me tell you, you have standards for each and every values here. Okay, in order to calculate the value of property, plant and equipment, you have certain standards, that is IAS 16, IAS 40, IAS 20. All these things will help you to ascertain the value of property, plant and equipment. Then to calculate the value of investments, you have IFRS 9. Now value of intangible assets, to calculate value of intangible assets, you have IAS 38. Okay, so these are the 3 non-current assets coming in your statement. Now we have current assets. Current assets are inventories, trade receivables, cash and cash equivalent, and asset held for sale. We have standards for each of them. For inventory, you have IAS 2. Then for trade receivables, you will be you'll be considering the value of receivables as per IFRS 15, revenue from contracted customers. Then you can have the value of cash and cash equivalents through cash flow statement, that is IAS 7, statement of cash flows. It is a separate statement, that is IAS 7. Then you have asset held for sale. The reference is IFRS 5. Okay, so in each and every standards, you are calculating a particular value that is necessary for your statement. Okay, what is the amount to be shown in SOPL? What is the amount to be shown in SOFP? So to get an answer, you have standards. Okay, so when you add up all these non-current and current assets, you can get total assets. Now we have the next subheading, that is equity and liability. In under this equity and liability, you can give another heading, capital and reserves, or you can give just equity. Okay, give a subheading, equity. Under equity, you have 4 main elements: share capital, share premium, revaluation surplus, and retained earnings. Otherwise, if you want, you can do like this: share capital and retained earnings. These are the 2 main items in SOFP. And you can add OCE, other components of equity. In this other components of equity, there will be revaluation surplus, share premium, and the remaining equity elements. Okay, if you want, you can split and record. That is share capital, share premium, revaluation surplus, retained earnings. You can split all these elements and you can record it under the equity. Otherwise, you can consider them as other components of equity. Right? What is this? No, Karthik?
Sorry.
You were chatting with somebody else? It's okay. I thought the concept that I explained was wrong. Okay, it's okay. So if you want, you can give a separate heading equity. And under the equity, there are 4 main elements: share capital, share premium, revaluation surplus, and retained earnings. And you gave a total. Okay, total equity. Calculate the total equity and keep it there for now. Then the next subheading coming under equity and liability is liability. You have classification for liability, that is non-current liability and current liability. Under non-current liability, the 2 main items coming are long-term borrowings and deferred tax. For long-term borrowings, you have IFRS 9, and for deferred tax, you have IAS 12. Then, for current liabilities, there are trade payables, short-term borrowings, current tax, and short-term provisions. For provisions, you have IAS 37. Current tax, there is IAS 12. Then, for trade payables, we also have this provision thing. IAS 37 can itself can be considered referred for calculating the amount of payables. Okay, so there are references for each values. In order to ascertain each and every value in the statement, you can take the help from IFRS or IAS standards. Okay, so that is why we are learning all these standards in financial reporting. Since our aim is preparation of statements, we need to learn these standards because these standards gives you the rules and regulations and the solution of what value to be taken to what statements. Okay, so this is the important, very, very important format that you need to keep in your mind. Pro forma for SOFP. Now, this is the pro forma for SOPL and OCI, Statement of Profit or Loss and Other Comprehensive Income. When you look at the heading, Statement of Profit or Loss and Other Comprehensive Income for the year ended. When you were preparing SOFP, your heading was as at 31st December or as on 31st December. You are considering the values on a particular date. But when you're preparing SOPL and OCI, you're considering the values of a whole year. Throughout the year, what are the incomes that you generated? What are the expenses that you incurred? All those things will be included in SOPL and OCI. So in this format, you basically have two elements, that is income and expense. Okay, there are 5 elements, and among these 5 elements, 3 of them, asset, liability, and equity, is included within SOFP, and the remaining 2, income and expense, will be included in SOPL. And whatever income you generated for a particular year, and whatever expense that you have incurred for this year, that will be included in SOPL. And once you got the profit or loss figure, after that, you will be giving a new subheading, other comprehensive income. Under other comprehensive income, only 2 things will be coming, the gain or loss on revaluation or the gain or loss as per fair value through OCI model, FVTPL model under IFRS 9. Okay, so this is the basic format for SOPL and OCI. You get gross profit when you deduct revenue from cost of sales. Then you have 2 expenses, that is administrative expense and distribution expense. Together, you can call them operating expense. This administrative expense and distribution expense, you will be calling them operating expense. Some companies will be preparing statements and they will be recording them separately. That is, this administrative expense and distribution expense, they will be recording separately. And some companies, they will be including both distribution and administrative expense, they'll be combining it together and they call it operating expense. So when you deduct operating expense from gross profit, you will be getting profit from operations or operating profit, or you can call it PBIT, profit before interest and tax, or net profit. Okay. Now from PBIT, if you deduct finance cost, that is interest expense, and you can add investment income, making these 2 adjustments, you can get your profit before tax, PBT. From this, if you deduct the income tax expense, you will be getting profit during the year, profit for the year, or profit after tax. Okay, so this is the basic pro forma for SOPL and OCI, which incorporates all income and expenses generated during the year. So these are the 2 important statements, SOPL and SOFP. Now, this is the pro forma for statement of changes in equity, but just as I told you, we don't need the format. We don't need to learn the format for statement of changes in equity. Understand what are the adjustments happening here. We have 4 elements for equity, that is share capital, share premium, revaluation surplus, and retained earnings. So whatever adjustment is happening in all these 4 elements during a year, that will be coming under the statement of changes in equity. Okay, first take the initial balances. That is the previous year's balance brought forward, the opening balance. And during the year, this prior year adjustment is where you have an error. Okay, This happens only when there is an error. We will discuss based on the errors in IAS 8, prior period error. Okay, so whenever there is an error, you will have to make adjustments to the retained earnings. Then you will get the restated balance from this opening balance itself. If there is no error, the opening balance itself will be the restated balance. You don't need to do it separately. So if you have a share issue during the year, it will be affecting the share capital and share premium. You'll be adding the issue to this share capital and share premium. Then when there is a total comprehensive income, this total comprehensive income includes two items: profit or loss for the period, and you have other comprehensive income, the value from SOPL. So only after preparing SOPL, you can prepare statement of changes in equity and statement of financial position. Okay, so if there is a profit, you will be adding the profit figure to the retained earnings, and whatever there is in the other comprehensive income, you will be including it under a revaluation surplus. That is why you have two values here. So in other comprehensive income, if you have a value, that will be recorded under revaluation surplus, and whatever is the profit for the year from SOPL, you will be recording it, you will be adding it to the opening balance of retained earnings. Then, if there is dividend paid, I skipped this. If there is a dividend paid during the year, that will be removed from retained earnings. From the opening retained earnings, the two adjustments are dividend paid, you will be deducting, and profits, you will be adding. That is the adjustment happening in retained earnings. And transfer to retained earnings, this is very rare and it is not mandatory. It is not mandatory. This is where you have to transfer excess depreciation from revaluation surplus to retained earnings. So since these two are equity elements, it doesn't make a difference for your statement. If your excess depreciation is 10,000, you deduct 10,000 from revaluation surplus and you will be adding the same exact 10,000 to this retained earnings. So it does not make an effect. Your net effect will be nil, zero. So it's not mandatory, but these are the maximum adjustments that can happen in an equity element of a company. Under equity, you have share capital. If there is a share issue, you will have to add the amount of share issue to the opening balance. That's the only adjustment in share capital. In the share premium also, only adjustment is where you have a share issue at premium. Then under revaluation surplus, you have two adjustments coming. That is, whatever value is included in the other comprehensive income, that will be added with the opening balance, and whatever is transferred to retained earnings, you will be removing this transfer value from revaluation surplus. Now, the most important adjustment that you have to understand from SOCIE is based on retained earnings. From retained earnings, you will be deducting the dividends during the year and you will be adding the current year's profit. So retained earnings, it is simply, you can assume this as a basket which has the profit accrued for every year. Okay, in the first year, you have some profit of 1 million. You put that profit in this basket, retained earnings. In the second year, you have a profit of 2 million. Again, you are putting this 2 million in the basket. So whatever is the profit or loss, if there is a loss, you will be deducting this value from the retained earnings. Okay, so retained earnings is a basket which has the profit and loss for the company. From this profit only, you will be giving dividends to the shareholders. That is why you are deducting this dividend value from retained earnings. So retained earnings has the profit for every year, and from this retained earnings, you will be removing whenever there is a loss. You will be having a deduction whenever there is a loss and whenever you are paying dividends. Okay. So these are the adjustments coming in statement of changes in equity. You just need to understand what all adjustments are happening, what all additions are happening, and what all deductions are happening in these equity elements. Okay. So these are the basic formats that you need to know. About cash flow statement, we will be discussing it separately as IA 7. Okay. So I hope you got an idea, you got the picture of SOFP and SOPL in your mind. These are the statements that you can expect for your essay question, 20 mark essay question. Okay. Now can we go to the statements one by one? Anything else you need to ask me? Yes. Great. So the first standard that we are considering is IAS 16, property, plant and equipment. So when your company is having a purchase of a non-current asset, or when you are planning to dispose of a non-current asset, or when you are revaluing the assets, all these situations comes under IAS 16. So IAS 16 is laid down by IASB as a solution for what value to include based on an asset in your statement. Okay, based on the non-current asset. And make sure this non-current asset that you are considering under IAS 16, it is only based on business assets. Business asset. Assets that you use for business purpose is treated under IAS 16. So what happens if you have any other assets that is not used for business purpose? For example, if it's used for rental purpose. Anybody know? We have another standard for this. We have a non-current asset. Non-current asset, for example, plant and machinery, building, furniture and fixtures. Yes, investment property, IAS 40. Very good. So, if you are planning to, if you are making use of this asset as an investment property, for example, you have a building and you are not using this building for office purpose. It's not for business purpose. You are giving this building as a rental. Okay, this is used for rental purpose or investment purpose. For that case, you have a separate standard. So don't always think that every land and building will come under IAS 16. So whatever assets that you use for business purpose, that comes under IAS 16. The recognition criteria is it is possible that the future economic benefits associated with an asset will flow to the entity. This is, we already told that it's regarding assets. To be an asset, you need to understand that there must be probable, it must be probable that you will have future economic inflow, future economic benefit. Then another condition is the cost of the asset can be measured reliably. So if you cannot, like you have a gift, you got a gift from somebody else, and it is a very unique thing. You don't have a value. Either you cannot get its historic cost. You did not give any money as it's a gift. You did not give any money, so there is no historic cost. And it's not a branded item. It is not available in the market, so you don't have a current cost also. Now, when you're looking for the fair value, nobody is going to give you any money for this. Okay, it does not have a market value also, and you don't have a future inflow also. For example, a statue. Okay, it's an asset, a very big painting or a statue. If in that case, these assets are not accounted under IAS 16 because it does not have a cost which can be reliably measured. It does not have a cost that can be measured reliably. So if these two conditions are met, it must meet the definition of an asset and it must also have a reliable measurement. Okay, a cost can be measured in either way. Okay, using any of this measurement basis, you need to ascertain the value of this asset. If measurement is not possible, then it will be excluded from the scope of IAS 16. Okay, so these are the recognition criteria, and every business asset will be included under IAS 16. As per IAS 16, initially, when you are purchasing the asset, so for every can you please mute that? Yes. Okay. So for every standard, you have this initial measurement and subsequent measurement. It simply means what is the initial value at the date of acquisition, okay, or at the date of commencement. The initial value of a non-current asset simply means the value to be recorded in the journal entry. Value. Your first recording happens in the form of journal, isn't it? Accounting procedure. First, journal entry. Second, ledger. Third, trial balance. And fourth, financial statements. So, value to be shown in journal on the initial date, at the date of acquisition. Suppose you are purchasing an asset in August and maybe you are preparing statements as your year end is 31st December. So, as on August, when you bought this asset, what is its value? That is the initial value. Okay, this is the initial value to be recorded in the journal. This initial measurement is at cost. And what is the meaning of cost here? Cost. Cost includes all these things. See here, you have purchase price, import duties, cost of site preparation, then initial delivery and handling cost, installation cost, testing, professional fees, site overhead, and present value of dismantling cost. So these are the items included within the cost. Okay, in the initial cost, when you are writing a journal entry for acquisition of an asset, then at that time the amount to be recorded in the journal entry is the total of all these figures. You need to learn this. In short, you can say that purchase price plus all direct expenditure incurred to bring the asset to its present location and condition. Okay, when it's available for use, until it's available for use, whatever is the direct expenditures incurred for a company in order to bring the assets to its present location and condition, that is included within the cost. Okay, got it? You need to learn this. That is the initial value. Initial value is not recorded in the statement. In the statement, when you're preparing statement as on year end, you will be giving a separate value. That is called subsequent value. Initially, maybe for 2 months, they'll be asking what is the initial value to be recorded in the journal entry. At that time, you need to understand that amongst all these costs, you can add up all these costs incurred for a company when you're acquiring an asset. That is the cost to be included as the initial value. Then what should be excluded from cost? All administrative and general overhead. See, specific overheads, site overheads can be part of the cost, but general overheads will not be included within cost. Then startup and pre-production costs, abnormal waste, warranty, business rate, training costs. Just go through these. Whatever is included here, these will not be coming under cost. Okay. Now, initially, you will be recording in the journal entry at the cost. The asset will be recorded at its cost. But subsequently, when you are preparing the statement, what is the subsequent expenditure? Subsequently, you can classify the value of asset into two. You have capital expenditure and revenue expenditure. Capital expenditure, it is something that you can capitalize. Capitalize means it can be shown in SOFP. Okay, so you will come across this term eventually in this chapter, regularly in this financial reporting subject. To be capitalized means the value can be recorded in the SOFP as an asset. Then it cannot be capitalized or it need to be expensed means this is just a revenue expenditure to be shown in SOPL. So any value that can be included within the value of an asset is called capitalization. Then any figure which is just a normal expense to be shown in statement of profit or loss is known as revenue expenditure. For example, in capital expenditure, you have a criteria. You can note down this criteria. The amount, a subsequent amount to be capitalized means this particular expenditure must help to enhance the performance of an asset. Okay, it leads to performance enhancement of an asset, of existing asset. That is capital expenditure. So, for example, you have a machinery and every month from this machinery, you got 5,000 units as output. Now, you added a new component to this machinery. From now onwards, after adding this component, new component, you are getting 7,000 units as output every month. So, which means the performance of this asset, this machinery have enhanced. So, whatever cost you have incurred for this performance enhancement, that can be included as part of the cost of assets. Okay. So, capital expenditure means any expenditure that can be capitalized and can be shown in the SOFP. And this there is one criteria for the cost to be capitalized. So that is the performance enhancement of an existing asset. Any cost that is incurred to enhance the performance of an asset is known as capital expenditure. And you have two examples. First one is adding new components. And second one is overhaul expenditure. We'll discuss what is overhaul. Okay, overhaul expense. So these are the two examples for performance, for capital expenditure where the performance enhancement of an existing asset happens. Then you have revenue expenditure. These are normal expenditures like repairs and maintenance. Repairs and maintenance. These expenses, these are just included within your SOPL, your administrative expense. Okay, that's about capital and revenue expenditure. And subsequent, the term meaning is in the statements. Subsequently means value in statements. Value to be included in FS, financial statements. So subsequently, any capital expenditure will be included in SOFP and any revenue expenditure based on an asset will be included in SOPL. And what is the initial measurement? Initial value means the value to be shown in the journal entry. Subsequent value means the value to be shown in the financial statements. Subsequently, an asset can have capital expenditure and revenue expenditure. If it's a capital expenditure that helps to enhance the performance, then it can be capitalized in SOFP. If it does not lead to a performance enhancement, it is just for day-to-day maintenance. In that case, this expense is known as revenue expenditure and it will be included in the SOPL. Okay, got it? What is the subsequent values? Your next concept is depreciation. Subsequently, to calculate the amount of an asset to be shown in SOFP, you need an item called depreciation. What is depreciation? You might already be familiar about depreciation. Depreciation is the systematic allocation of depreciable amount of an asset over its useful life. Okay, so what is a depreciable amount? Depreciable amount means cost minus residual value. Whatever is the cost of the asset that you had initially recorded in the journal entry, that initial cost minus residual value or scrap value. When you are selling this asset after its useful life, what is the value that you can get? What is your expectation? That is the residual value. Okay, so initial cost minus residual value, that is the depreciable amount. And when you divide this depreciable amount using the expected useful life of an asset, you will be getting this depreciation, amount of depreciation. You know what is depreciation? Is it an asset, liability, equity, income, expense? What is this depreciation? In which element depreciation comes? Expense. Great. Very good. Even here, you can see that depreciation is a systematic allocation of the amount, of depreciable amount, isn't it? So this is the allocation of income, to be frank. Okay. Depreciation is an expense. Depreciation is an expense which is matched to with the corresponding income generated per year from an asset. Okay, so you have a concept called matching concept. Based on the matching concept, you will be matching every income for a year. For 1 year, if you have an income, there will be a corresponding expense. That is the matching concept. So, from an asset, you will be generating income, isn't it? For example, if there is a machinery, from a machinery, every year you will get income. So, for matching this income, you have a particular expense known as depreciation. So depreciation is not an actual expense. You are not paying any money. Usually, what is expense? Anything that a company incurs in the form of payments, outflow. But depreciation is not an actual outflow. And why is this concept important? This is based on matching concept. Okay, you are matching the income generated from an asset per year to a corresponding expense. That is depreciation. Depreciation must be charged from the date the asset is available for use. This is a point that you need to keep in mind. It's not the date of purchase. Usually we consider that as soon as we purchase an asset, we can make use of this asset. But in some rare cases, it will be like after purchase, it takes time. It takes 3 or 4 months for you to make it available for use. So in that case, this available for use date will be considered for depreciating. Okay, from this date, the asset is available for use. From that date onwards, you will be calculating depreciation. Usually, we consider the purchase date as the date on which asset is available for use. Got it? This is a very important concept. In the coming all standards, you will have to have the knowledge of this depreciation concept. Okay. The depreciation is an expense and every expense will be recorded in SOPL. Yes, depreciation comes only under cost model. We'll come to it. We have two models, that is cost and revaluation model. But the thing is, depreciation comes under, we cannot say that depreciation comes under cost model. Depreciation is there in revaluation model also. But the point is, the depreciation value changes every year. You need to calculate the depreciation every year when there is a revaluation. Otherwise, if you are following cost model, at once only you need to calculate the depreciation. Okay, every year the depreciation will be same only as per cost model. Okay, you have one more model, that is revaluation model. If you are choosing that model, at that time also you have depreciation, but every year the value of depreciation will be new. Okay, new value of depreciation must be calculated. We'll come to it. Here, just understand that the normal way of calculating depreciation is cost minus residual value. But if you are following another model, that is revaluation model, we will have a small change to this equation. Okay, got it? Yes. Now, we have three methods for calculating depreciation. That is straight line method, reducing balance method, and machine hour method. You don't need to know about machine hour method, it's not important. But straight line and reducing balance method is important. As per straight line method, you have to calculate the value of depreciation at once. Okay, every year, the amount of depreciation will be same. Same amount every year. But as per reducing balance method, the amount of depreciation will be reduced every year. Depreciation is reduced every year and it becomes zero at the end of useful life. If the asset's useful life is 10 years, then in the 10th year, the depreciation for the asset will be zero as per reducing balance method. As per straight line method, every year there will be same amount of depreciation, that is cost minus cost minus residual value divided by useful life. That is as per straight line basis. But if you are following reducing balance method, the depreciation amount reduces every year. Got it. These are the three methods available. And when can you go for a change from one method to another? Currently, you are following straight line method. And in the next year, you are planning to choose reducing balance method. Is that possible? Let's see. It is permissible only on the grounds that a new method will give a fairer presentation of results and of the financial position. So, if you are following reducing balance method, like if you are changing from reducing balance method to straight line method, you need to have some proof that this new method will help you to give a fairer value. A more accurate figure can be calculated. If you are able to prove this, then you can switch from one method to another. Then another case is if it does not constitute a change in accounting policy. We'll discuss what is accounting policy in IAS 8. Okay. In IAS 8, we'll discount what is accounting policy. So it's just that this change from one method to another, it does not constitute a change in accounting policy. Accounting policy is different. This is just methods for calculating depreciation based on estimates. Okay. So that is what is mentioned here. This is based on accounting estimate. This is a change in accounting estimate and not a change in accounting policy. And the change is only possible on the grounds that it leads to a fairer presentation or if it's required by a new IFRS standard. Okay, got it? So that's about the depreciation. Then, whenever an asset's useful life is reviewed or revised, or if the residual value is revised, in that case, you will be calculating new depreciation. New depreciation equal to cost minus new residual value divided by cost minus. if there is a revised residual value, then cost minus revised residual value divided by revised the remaining useful life. Okay, so that is the new equation. Whenever there is a revision in useful life or residual value, you will be calculating, even if you are following straight line method. As per straight line method, every year you have the same amount of depreciation, but in between, if there is a revision happening for the residual value or useful life, in that case, even if you are following straight line method, you will be calculating new depreciation as on that date. Yes, carrying value as on that date will change. Okay. How the company will prove that old depreciation is not good? It is based on an IFRS standard. Like if you have a new IFRS standard, uh, for example, I can give you as regarding machinery. You were following straight line method for machinery. As per straight line method, every year you are calculating same amount of depreciation, isn't it? But as per the matching concept, only we are following depreciation, we are calculating depreciation. But when you are matching to the income generation, every year you found that this machinery is giving you reduced income. For the first year, from this machinery, as this machinery is new, you got one like what 10,000 as your income. In the second year, from this asset you got only 5,000. From the third year, you got only 4,000. So in that case, you have noticed that this machinery is giving you income on a reduced basis. So when you're matching this income with an expense, depreciating on a straight line method is not a fairer way. So for the machinery, which you found that income generation is on a reduced basis, you can prove that since the income generation is reducing every year, we will follow the reduced balance method. Straight line method is not the appropriate method for matching with this income. Like that, you can prove. Got it? And all those things will not be tested for your exam, just for your knowledge. You can keep this in mind. Understand the concept of depreciation well. So when you understand what is depreciation, what is the point of calculating depreciation, then you can see whether reducing balance method is apt for this, like what, machinery, or whether straight line method is apt for this machinery. When it comes to building, it is not like the building or the land will give you a reduced value every year. Okay, from a building, it is located in if it's located in a prime location, maybe if the location is infrastructure wise, if it's growing, then your building's value will be increasing. So you can follow straight line method itself. You don't need to follow reduced balance method for a building, because the income generated from a building possibly will not be reducing every year. Okay. So we have to calculate new depreciation whenever there is review of useful life or residual value. Then we have one new concept called overhaul. Overhaul expense is actually a major inspection happening in a company, but we are considering it as a tangible non-current asset. See, it does not overhaul expense, overhaul cost. It is not an item. It is not a non-current asset, but we are considering this as a non-current asset, as part of a non-current asset. Because with this overhaul expenditure, you are expecting the value of your assets to increase. Okay, that is from this certification. If this inspection is over and you have proved that all assets or your company is having like what a good condition, a very good condition, you got a certification. So based on this certification, the value of asset will be increasing. So anything that increases the performance or value of an asset, that is considered as a subsequent expenditure that can be capitalized, isn't it? So this overhaul expenditure, if you incur an expense for this inspection, this expense will directly lead to the performance enhancement of your asset. That is what you are assuming. So based on this assumption, they are capitalized as non-current assets to the extent that they satisfy IAS 16 rules for separate components. So you're considering this overall expenditure as for the expense incurred for a separate component. Okay, if you're considering this as an asset, what happens? There is well, this is the case, they are then depreciated over their useful life, that is until the next inspection or overhaul is due. So when your next inspection is due, after every regular interval, you will be going for overhaul inspection. Okay, so if it's every 5-year duration. Then for 5 years, you will consider the duration 5 year as the useful life of this asset, and you will be depreciating this overhaul cost. Okay, so you are considering this overhaul, you are assuming this overhaul expenditure as an item, as a non-current asset, and just as you depreciate a non-current asset, you will be depreciating this what this overhaul expenditure till the next useful till the next overhaul expenditure. Okay, from one overhaul, if one overhaul expenditure happened in December 2001 and the next overhaul is scheduled after 5 years, then 5 years will be the useful life of overhaul. So as the straight line method, depreciation is equal to cost of overhaul divided by useful life, 5 years. Got it? That is overhaul. Then subsequent measurement. For subsequently measuring assets of a company, you have two models, that is cost model and revaluation model. As per cost model, carrying amount equal to cost minus accumulated depreciation minus impairment loss. Accumulated depreciation means whatever is the cumulated total of the depreciation till date. That is accumulated depreciation. From the initial cost, if you deduct the depreciation total till date, and if there is any impairment is not a regular event. If there is any impairment, we'll discuss about impairment in IAS 36. If there is any impairment, that is also deducted from the cost, and the remaining value is known as carrying amount. This carrying amount is the amount shown in SOFP as non-current asset. Okay. And if the company is following revaluation model, then carrying amount will be revalued amount minus accumulated depreciation minus impairment loss. So here also you have depreciation, but here depreciation is calculated on revalued amount. We will see what is revaluation, what is the concept of revaluation. And whenever there is a revaluation, you need to recalculate your depreciation. Okay, the depreciation till date, everything will be erased. Okay, we don't have a cumulative depreciation when you were following cost model. Every year's depreciation will be added, isn't it? But in case of revaluation model, you will be erasing every accumulated depreciation till date, and from the date of depreciation, you will start calculating the new depreciation, and that will be accumulated. Okay, we will discuss it later in the next slide. And the same policy must be applied to the entire class of assets. Means if you are choosing cost model, then whole class of assets, means building is one class. If you have two buildings, you cannot revalue one building and you cannot follow cost model for another building. For every building, you need to follow one method itself. Likewise, yeah. Likewise, if you are following reducing this revaluation model for machineries, then for every machinery in your company, you will be following the same model. For one machinery, you can choose revaluation, and other you can choose cost model. It is not possible. Okay, so that is mentioned here. For the entire class of assets, you need to follow the same policy. Okay, so these are the two methods, the two models available for companies to value their non-current assets. Now, when the company is following revaluation model, these are the 5 things that you need to do. As an accountant, okay, as a senior accountant, when you are preparing your statement and in your company, a revaluation took place. What is revaluation? You are checking the value of your asset in the market. If the fair value of the asset is greater than your carrying amount that you have recorded on this previous statement, at that in that case, you will be having a revaluation surplus. Okay, there will be a revaluation surplus or loss where you are comparing the fair value and the carrying amount. The carrying amount as on that date minus the fair value of this date, or you can do the reverse, fair value minus carrying amount. If you get a positive figure by doing this equation, if there is an increased market value for your asset when compared to the carrying amount, in that case, this increase is known as revaluation surplus and the decrease is known as revaluation loss. So, whenever there is revaluation, us as senior accountants need to follow these steps. Restate the assets cost to its new valuation. Now, the assets cost will not be recorded in the SOFP. We are restating the cost to its new revalued amount. And from this revalued amount, you will be deducting the new depreciation. Okay, so eliminate any existing accumulated depreciation. Okay, any existing accumulated depreciation is removed and we are calculating new depreciation. Okay, show the total increase in other comprehensive income at the foot of this SOPL. In SOPL, we had another subheading, other comprehensive income, and the amount of revaluation surplus will be included in other comprehensive income, OCI, and from the OCI, the same value will be taken to revaluation surplus that we discussed in statement of changes in equity. Okay, so we have to do all these things. The new value minus depreciation for the new depreciation. New value minus new depreciation will be recorded in SOFP. Any accumulated depreciation till date will be eliminated. Then the amount of revaluation surplus will be taken to OCI and the same value will be taken to equity under SOFP. That is why SOFP is given here. Then you need to calculate the new depreciation and the new depreciation will be taken to statement of profit or loss. Then if there is a change in depreciation, there will obviously be a change in depreciation. That is initially before revaluation, you had depreciation as 1000, for example. And after revaluation, you got the new depreciation as 1500. So the difference between these two, difference between 1000 and 1500, this 500 will be considered as change in depreciation and it is transferred from revaluation surplus to retained earnings. This happens within the equity element itself. Under equity itself, you are transferring from revaluation surplus to retained earnings. This is not mandatory. Second point, eliminate existing accumulated depreciation. For example, if you are revaluing regularly every year, and it is not necessary that every year you need to do revaluation. But if you are revaluing regularly means this second sentence is of no relevance. Okay. In December 2001, you had a revaluation. December 2002, you had a revaluation. In that case, the second sentence is not relevant. But usually what happens is 1 year, let's say in December 2001, you had a revaluation and after 3 years, you are doing the second revaluation. So from the first revaluation, you will be calculating a depreciation and this depreciation will be there in year 1, 2 and 3 until there is the next revaluation. So whatever is the accumulated depreciation till that date, okay, from the first revaluation till the next revaluation. Or sometimes there may be a switch from cost model to revaluation model, isn't it? So when you are doing a revaluation, until that date, whatever is the accumulated depreciation, that figure will be erased. You will not be considering that accumulated depreciation for calculating the carrying amount. The accumulated depreciation that is used for calculating carrying amount is the new accumulated depreciation from one revaluation date till the next revaluation date. Got it? Yeah, let's say if you had a cost 10,000 and your useful life was 10, in that case, depreciation per year will be 10,000 divided by 10 years, that is 1,000. Now, for the first year, you recorded depreciation 1,000 and second year, you recorded 1,000. Now, your accumulated depreciation is 2,000 for the second year. In the second year, when you are calculating this new depreciation based on a revaluation that took place, this new depreciation will not be 1,000, isn't it? New depreciation will be different. So on that date, you will be releasing this 2,000. Whatever is the previous accumulated depreciation, till that date, just erase it. Just eliminate it. That is not required for our calculation. We only need the new revaluation to be recorded in the SOPL. Yes. So these are the things happening in SOPL. Sally, can you please? Yeah. So these are the things happening in the statements when you are doing a revaluation. In SOFP, the new value will be the revalued amount of the asset will be given. Then any depreciation till date will be ignored, will be eliminated. The revaluation surplus will be shown under OCI and the same amount will be taken to SOFP under equity. Then new depreciation will be shown in SOPL and this last point, it is not mandatory. Only if it is specified in the question, you can do this. Okay. If it's specified that a transfer is necessary, in that case, whatever is the excess depreciation, this excess depreciation will be transferred from revaluation surplus to retained earnings. Deduct the value from revaluation surplus and add the same figure to retained earnings under equity. These are the things happening in the statements whenever the company has a revaluation of an asset. Then, when you are disposing a revalued asset, disposal means sales. What is the term meaning of disposal? It means sales. So when you are selling a non-current asset, you have two things to do. First thing is, it should be accounted for in SOPL of the period in which the disposal occurs. So in SOPL, you need to record the gain or loss. It means the gain or loss. Here, profit or loss on disposal of revalued asset should be calculated as difference between net sale proceeds and carrying amount. So simply you can say that gain or loss is equal to sales proceeds minus carrying amount as on that date. This gain or loss should be calculated whenever there is a disposal. Gain or loss is calculated and is recorded in the SOPL. Then one more thing that you have to do is any balance on the revaluation surplus relating to this asset should now be transferred to retained earnings. So here there is a transfer from revaluation surplus to retained earnings. Again, if you have you are selling a revalued machinery, for example, in that case, this machinery has a revaluation surplus in the equity, which is 10,000. So when you are disposing this, the 10,000 amount from the revaluation surplus will be deducted, and this 10,000 will be added to retained earnings as a part of profit. Okay, the assumption is like anything in the other comprehensive income is unrealized. So when you are disposing this asset, the amount is actually realized, and this realized value is shown in the retained earnings. So there are two things that you need to consider whenever there is a disposal. First one is calculate the gain or loss and show the gain or loss in SOPL. Second one is transfer the value based on revalued amount, revaluation surplus based on this asset from the revaluation surplus to retained earnings. These are the two things that you need to do whenever there is a disposal. So that's all about IAS 16. When you are buying an asset, what happens? Okay, what is the initial cost? What is the subsequent expenditure? How to classify among capital and revenue expenditure? Then what is depreciation? What are the methods of depreciation? What happens when there is a revision in useful life or residual value? Then what is the major inspection and how to treat overall expenditure? Then subsequent measurement, that is, you have two choice, cost model and revaluation model. Then whenever there is a revaluation happening, what are the 5 things that you need to do? And when you are disposing an asset, what are the things to consider? So that's all about IAS 16, property, plant and equipment. Anything regarding a business asset. Okay. And next is IAS 23, borrowing cost. So before going into borrowing cost, let's take a short break. Because we have already covered 2 hours. So let's take a short break of 10 minutes. You can also drink some water, go fresh up and come. And we will continue with IAS 23 and we'll take the remaining standards and consolidation and interpretation after the 10-minute break. Okay. Please be back by 6:10. Now it's 6 p.m. By 6:10, we will continue. Yes, Ashit, we will possibly do it. And maybe we will be extending our class to another 15 minutes or 20 minutes. But my point is, till now we were discussing the basics. Now the remaining standards have like what? The remaining almost 10 standards have connection with this depreciation and revaluation and all those things. So we can rush. I just need to tell you the initial measurement and subsequent measurement so we can run. Okay. Anyway, we'll be covering the entire topic. Don't worry about that. Uh, Kanika, I didn't understand you. What is the SS? SS of all FR class means? Screenshot. Why do you need a screenshot of the class? Like you're asking for the recorded video or something like that. The recorded video of this revision class will be uploaded in the YouTube. And the remaining sessions, you can ask in the group. We have a hotline number, including leases, taxation, FA, and financial asset and liability. Yes, we are planning to do it, but let's see how it goes. Yeah, if it's the PPT, then I'll share the PPT. If you text me personally, this is my number. You can text me personally. I'll share you the PPT. Yes, you're asking about recorded video. Okay. So the recorded video is, wait a second, I'll give you a hotline number. You contact in this hotline number. They will be giving you the ID and password of an LMS platform, and through the LMS platform only, you will be getting these recordings of live classes, all live classes. Okay. If it's about this revision class, this will be freely uploaded in the YouTube. This is the hotline number. I've typed it in the chat box. You can contact this number for any concerns regarding recorded videos or the plan materials or whatever. Okay. Yes. Deepakshi, we'll be discussing this plan in tomorrow's class. That's what I told you. I'll guide you based on the materials provided by ACCA about the platform and how you can plan for your studies. Okay, but make sure that till this date you have covered all portions. Okay, now you don't have time for completing your portions. Now it's time for your question practice, mock exams, and all those things. So I'll give you a plan tomorrow itself. Okay, and I'll show you how to make use of your MyACCA account. Yes, yes, yes. Okay, I hope you're there. Can you please respond in the chat box? Can we continue?
Yes.
Yes, great. So our next standard is IAS 23 borrowing cost. This borrowing cost is also connected to the non-current asset, the value of property, plant and equipment that you are going to show in your SOFP. This borrowing cost standard is also connected to that. But the name doesn't seem like that. What is borrowing cost? Whatever is the cost incurred on borrowed fund, that is borrowing cost. If you are borrowing money from somebody, if you are borrowing money from a bank, that is known as loan, isn't it? On that loan, you will be having interest charges, and this interest is known as financing cost, or you can call it borrowing cost. So our concept is very simple. See here, you have a timeline. Okay, this is the timeline. You took a loan as on this date. The date is 1st January, for example. This is 1st Jan, and 1st Jan you took a loan. And on this date, the purpose of this loan was to build a building, to construct a building. And you started construction on 1st March. Okay, on 1st March, you started construction. You had your construction till this period, that is till 31st November. So from 1st March to 31st November, how many months are there? 1st March to 31st November. How many months? 10 months. Okay. Is it 10 months? Sure. 9 months. Yes. It's 9 months. So this 9-month period, you call it construction period. And after 9, the year end, after November, the year end is 31st December. 31st December. So my point is, this period from 1st March to 31st November, during this period, whatever interest charges that you incur based on the loan that you have taken for construction purpose. So your purpose must be crystal clear. You would have taken a loan for the construction of a qualifying asset. Qualifying asset means, here is the definition, asset which necessarily takes a substantial period of time to get ready for its intended use or sale. Okay, so any asset that takes significant period of time to get ready. Okay, for example, bridges, buildings, and any other items that takes time to get ready for its use. So usually, construction of building will be coming for your exam. And the situation is like this: on 1st January, you took a loan for 10 million, and in March 1st only you are starting the construction. But what about this loan interest? It will not wait for you to start the construction. As soon as you take the loan, from that date onwards, interest charge arises every month. Okay, from 1st Jan to 1st February, you have 1 month interest. Then till 1st March, you have 2 months interest. So these 2 months interest, this interest will be shown in SOPL. Okay, as finance cost, we know all income and expense will be shown in SOPL. So likewise, this will be shown in SOPL as normal interest expense. Okay, you took the loan on this date. Then you started construction on this date. Then on 31st November, your construction ended. And 31st December is year end, FS preparation. Okay, so on this year end, when you are preparing statement, in your SOPL, you will be including the value of first 2 months, that is January and March, and this 1 month period. Okay, this 1 month also will be coming in SOPL as interest or finance cost. Okay, now you have an exemptional case here, that is from 1st March to 31st November. This period is known as construction period, and during the construction period, whatever interest charges arises, that is for 9 months, if you have an interest charge for 9 months, whatever is the interest incurred, the interest will be capitalized. Capitalized means what we discussed. Capitalized means it will be included within the value of asset and shown in SOFP. So it will be capitalized and shown in SOFP as non-current asset as part of this building. Okay, whatever you are constructing as part of the cost of this asset, you will be capitalizing this interest for this 9-month period, for this construction period. Okay, usually interest is an expense that comes in SOPL, but as per IAS 23, the rule we are learning is for a qualifying asset, if we took the loan for the purpose of construction of a qualifying asset, of a non-current asset, in that case, during the construction period, whatever is the interest arising, the interest for that period will be capitalized and shown as an asset in SOFP. Okay, the interest before this construction and interest incurred after this construction, those interest will be shown in SOPL. Okay, so 9-month interest will be, if the interest loan amount is 10 million, this is just an illustration. Loan amount is 10 million and interest rate is 10%. In that case, can you tell me the amount to be capitalized in SOFP and amount to be shown in SOPL? With this same example, amount, any question can come. Amount to be shown in SOPL will be asked, or amount to be capitalized can also be tested. The amount to be capitalized is 10 million into 10% into 9/12 for 9 months. Then, is that the value that you get when you solve this equation? Ashit? Yes. Okay, great. And what about the amount to be shown in SOPL? It will be 10 million into 10% interest. This interest is per annum. So for the remaining 3 months, okay, first 2 months before starting and 1 month after ending. So this will be shown in SOPL. Okay, so this is a simple calculation. You can score 2 marks very easily. Got it? So the only concept you need to understand from IAS 23 is this. The interest that is arising on the period of construction can be capitalized and the remaining interest will be charged to SOPL as a normal expense. Yes, very good. Then, now one more thing that can come from this part is, what if you took a loan of 10 million and you don't need the whole 10 million on 1st March? So you are investing something for this period from 1st February till 1st April. For this 2-month period or 3-month period, February, March, April. For 3 months, you are investing your funds. Okay, if you are investing 5 million out of this loan amount, then whatever is the investment income arising in this period, during this construction period, you will be getting interest income, isn't it? So the investment income arising in this period will be deducted from this capitalization amount. Okay, now the 75,000 that you got, if this is a second case, if you are investing during this period, that is, for example, maybe from 1st January onwards, if you are investing from 1st January till 1st April, in that case, whatever is the investment income that you generate during this construction period, that will be deducted from the capitalization amount. The net amount will be shown in SOFP. Got it? And the investment income that you receive from this period, during this period, that will be shown in SOPL itself. On construction period, if there is an investment income arising, that investment income will be deducted from the amount to be capitalized. That is the 75,000 that you have calculated now. Okay. Or 750,000, whatever. Okay, got it? This is the only concept from IAS 23. If you understood this diagram very well, then that's all about this IAS 23. Okay, it's a quick recap. Next, we have IAS 40, investment property. You already told me that this investment property will be considered whenever an asset, a non-current asset in a company, is used for the purpose of rental or capital appreciation. If your objective is rental purpose or capital appreciation, in that case, this property will be treated as per IAS 40. As per IAS 40, the initial value will be at cost itself, just as IAS 16, whatever we discussed, initial measurement will be at cost. Cost includes so many figures: purchase cost, then installation cost, delivery cost, present value of dismantling, site overhead. All those things will be coming here also. So even if the asset is classified under IAS 40, as per IAS 40, initial cost is same as the initial cost calculation under IAS 16. Now, subsequently, here you have two models, that is cost model and fair value model. This fair value model is not same as revaluation model. Don't think like that. Initially for IA 16, you had two models, cost model and revaluation model. But for this IA 40 investment property, you have two models, but the second model, fair value model, even if it seems like it is similar to revaluation model, there is a huge difference. Let's understand. Once the model is chosen, it must be used for all investment properties. You cannot change the model. Okay. So if whatever investment property is there in your company, for all those investment property, you will be applying the same model itself. Let's see what is fair value model. The commonly used model among these two is fair value model. Okay. So as per cost model, this is exactly similar to IA 16, carrying amount equal to cost minus accumulated depreciation minus impairment loss. Okay. So you can write the same as IAS 16. But when it comes to fair value model, under the fair value model, the asset is revalued to their fair value at the end of each year. Every year, you need to regularly do revaluation. Okay. And the gain or loss is shown directly to SOPL, not OCI. In revaluation surplus model, where we accounted for in IAS 16, the revaluation surplus was shown in OCI, other comprehensive income. But when it comes to the fair value model of investment property, the gain or loss will be shown directly in SOPL, not in OCI. That is an important difference that you need to keep in mind. And one more thing is, when you are following fair value model, there will be no depreciation. Okay, you don't need to calculate any depreciation. Got it? So this is the only thing that you need to understand from IAS 40. You have two choices, you have two models. Initially, you will be measuring it at cost itself. The journal entry will be recorded at cost. Subsequently, you have cost model and fair value model. As per cost model, you have to record the carrying amount in SOFP. Carrying amount in SOFP equal to cost minus accumulated depreciation. But if you are following fair value model, you will be recording the fair value in SOFP. In SOFP, every year, fair value will be recorded. And in SOPL, you will be recording the gain or loss. Okay, you don't have any adjustment to other comprehensive income here. And when you are following fair value model, you will not be calculating any depreciation. This fair value is normally established by reference to current prices on an active market for properties in the same location and condition. We already discussed how to ascertain fair value and what is fair value, isn't it? So this fair value method is the common method used here. This is common. Okay, cost model is not common. Fair value method is the common model. By default, you can say that a property, plant, and equipment can be an investment property can be measured using fair value model. So that's all about IAS 40. You can solve any question from IAS 40 with this simple concept. Next is IAS 20, accounting for government grants and disclosure of government assistance. Here you have two things, government grant and government assistance. Can somebody please tell me the difference between government grant and government assistance? In simple terms, government grants and government assistance. Anybody? in simple terms, we can say that government grant is any financial support provided to a company by the government. So this is financial support provided by government to the company. So then what will be government assistance? Any guess? If government grant is financial support, then what will be government assistance? Government assistance will be the non-financial support. Very good. Okay, non-financial in the sense you can say in the form of some like what? Some subsidies or some reservations, okay, or some special allowances. Okay, so monetary support is government grant and non-monetary support is government assistance. This government grant, we will be recording it in the SOFP and SOPL. Let's see what values will be shown in these statements. Okay, you have adjustments to SOFP and SOPL. But for government assistance, no value will be recorded in the statement, but you have to disclose it in the disclosure note. Disclosure note or explanatory note is also a fifth statement, isn't it? So only you need to disclose about the government assistance. So our main treatment as per IAS 20, we are learning how to record for government grant, the financial support provided by governments to the company. When government is giving some money to the company, then how to treat this? Let's see. Government grants can be classified into two, that is revenue grant and capital grant. Okay. Revenue grant means anything that the government is providing for you to maintain your regular expenses. Okay. For example, your salary expense. Salary expense is a regular expense. It's not like a one-time investment for you. So for this, your SOPL expense, for meeting your SOPL expense, if government is giving you some support, that is known as revenue grant. For example, contribution towards payroll cost, that is contribution towards the salary, that is revenue grant. Whenever there is a revenue grant, you can include this grant as an income in statement. Grant is equal to it is an income in SOPL. No, government assistance is not examinable. You just need to understand what is government assistance and just understand that the assistance will be disclosed in the statements. Okay. Yes. So here, government grant, if it's a revenue grant, then it will be shown as an income in SOPL. And if it's a capital grant, now what is capital grant? If government is giving you some fund to purchase a non-current asset, you can call it capital grants. If government is giving you a capital grant, then you have two methods. The first method is netting off method, and the second method is deferred income method. Okay, so these are the two methods that you can follow to account for the capital grants. Okay, if government is giving you a capital grant, then either of these methods can be followed. If in your exam they are asking you follow netting off method, in that case, government will be giving you this fund for some purpose, isn't it? For example, they have given you the fund to purchase a building, to acquire a building. In that case, whatever is the cost, the actual cost of the building, deduct the amount that the government gave you. And the net figure is shown in SOFP. Okay, I'm discussing about netting of method. As per netting of method, whatever is your actual cost of the asset that you are planning to acquire, from the cost, you need to deduct the amount contributed by the government. The net amount will be shown in SOFP, and on this net amount, you will be calculating the depreciation, and depreciation on this net figure will be shown in SOPL. Okay. Now, when you are following deferred income method, then things are complicated. You have separate treatment for asset and liability. Okay. If it's for asset, as per deferred income method, under asset, you will be showing the cost of the asset, actual cost of the asset minus depreciation. Okay, that figure will be shown under assets. Okay, you as per netting off method, you deducted the government grant amount from the cost. Then only you showed it in SOFP. But when you are following deferred income method, under SOFP, under asset, you will be showing the actual cost. You are not doing anything with the grant here in the asset. You have a separate treatment for the government grant under liability. So under liability, just give an item deferred income. Okay. And this deferred income, I think I'll show it somewhere else. That is better. Here, I hope you can see this here. Whenever you are following deferred income method, as per deferred income method, you have both a treatment for accounting for asset and liability. So for the liability part, you will be recording in SOFP the deferred income means the grant amount. So you can say grant amount, or you can call it government grant as a amount, this deferred income. Whatever is the grant that you received from the government, from that amount, you will be deducting grant amortization. Grant amortization. Amortization is exactly same as you do depreciation, but this grant amortization is something different. So if your assets cost as 1 million and government gave you, let's say 400,000. So in the liability section, you need to record 400,000 minus 400,000 divided by useful life of the assets. Okay, government grant means the grant received divided by useful life of the asset. That amount will be shown under liability as deferred income. Okay, and as asset, what will you record under deferred income method? As asset, you will be recording the carrying amount. Carrying amount equal to cost minus depreciation. Okay, so this is what happens in SOPL when you are following deferred income method and you choose when you're following deferred income method and in SOFP you have to record a liability and an asset. But what happens in SOPL? Can anybody tell me with regards to this adjustment, what all values will be taken to SOPL? As per deferred income method. Yes, obviously depreciation will be there. So as an expense, you will be recording depreciation. Yes, we calculate depreciation on grant amount and that is known as amortized grant. Okay, grant amortization. So as an expense, we calculate depreciation and we show it in SOPL. And one more question is, you are right, very correct, very correct. Yes, amortization of government grants. But can you tell me amortization grant whether it's an income or expense? Yes, Harsh, you are correct. It's an income. But did you have any confusion regarding amortization? I already said that amortization is something exactly same as depreciation. Yes, so depreciation is something that you show as expense and amortization is also an expense. Okay, amortization is also an expense, but grant amortization is an income. Keep that in mind. Grant amortization is an income, but you have other amortization. Normally, if you're telling amortization, if somebody is asking you if amortization is an income or expense, you have to tell them that amortization is an expense. Okay, but grant amortization is something that is related to a liability. You are amortizing a liability means that will be considered as an income. So, as an income in SOPL, you can record this grant amortization. Grant amortization. What if the question asks to record initial value of grant? Initial value of grant is exactly the amount that you receive. Okay, whatever you receive from the government, that is the initial value. Got it? You don't have any calculations for that. If government is giving you 1 million, then 1 million is the initial value of grant. This is the subsequent treatment. Hadi, got it? Yeah. So subsequently, you have treatments for revenue expenditure and revenue grant and capital grant. For capital grant, you have two methods: netting of method and deferred income method. And deferred income method is something that is complicated, where you have to treat the asset and liability separately. And in SOPL, there will be an expense, that is the actual depreciation on the asset, and there will be an income, that is the grant amortization. Yes. I hope it's clear. So this is the concept of IAS 20. And just as I mentioned before, there is nothing regarding government assistance that you need to learn or by heart. You need to understand what is government assistance. That's it. For government grant, if it's revenue grant, then show the grant amount as an income in SOPL. You also have an alternative presentation, but just ignore it. It's not necessary. Okay. So if there is a revenue grant, you can show it as an income in SOPL. If it's a capital grant, you have two options. You can choose either of these two options. Okay. Got it? So that's all about government grants, IAS 20. I hope you're all there with your repayment of grant is also not regularly tested. If repayment happens, then you have to reverse whatever you have done. You remove the non-current asset. If you are following the netting off method, then in that case, from the net figure, you will be removing the amount of government grant received because you are repaying it. Sometimes there can be partial payment. So this partial payment amount, if you are repaying only 50,000, then remove 50,000 and recalculate the new depreciation. So the only point is, I've never seen such questions coming from repayment of grants. But if there is a repayment of grant, understand the concept. You have to reverse the thing. Okay, reverse. If you have followed netting of method and if you are repaying it to government, then remove the value from non-current asset. If you followed deferred income method for treating government grant and if you are repaying it, then remove the liability. Whatever we did now, you are just reversing it. You are just removing it. Then if it's a government grant, if government grant is being repaid, then we already showed recorded an income in SOPL, isn't it? So now you can show this as an expense or you can remove it from the government grant income. If it's a partial payment, government grant income, 1 million you recorded, and if you are partially repaying 100, let's say, 100,000, in that case, you can deduct 100,000 from the government grant income. If you are making a full repayment, you will be removing the entire 1 million. So you have to record a expense, government grant repayment expense in SOPL. It's not not very important. Debit the deferred grant and remaining amount goes to SOPL and credit asset. Exactly. Just pass the reverse entry. Okay. So all you needed is the basic concept. You just need to understand the basic concept of borrowing cost, basic concept of IAS 20 government grant. So there are additional points. If you go for additional points, then we cannot complete it in 2 hours. Okay. So that's it. I have included everything, every general topics. I mean, important topics here. And I'm discussing the basic accounting treatments for each standards. Okay. So I hope government grant is clear. IAS 20. Now we have IAS 36 impairment loss. IAS 36 impairment loss. The objective is to set rules to ensure that all assets of an entity are carried at no more than their recoverable amount. So IAS 16 is to ensure that the asset is carried at, like, the carrying value is not more than the recoverable amount. So when carrying amount is greater than recoverable amount, in that case, you can say that there is an impairment. Okay, so impairment loss is simply the difference between carrying amount and recoverable amount. Okay, so if you are required to calculate impairment loss, just say that impairment loss is equal to carrying amount minus recoverable amount. And this happens only if the carrying amount is greater than recoverable amount. Okay, so recoverable amount is somewhat similar to revalued amount, the market value. What happens if the market value is greater than the carrying amount? It's like it leads to a revaluation loss, isn't it? But you don't generally call it revaluation loss. You can call it impairment loss instead. Okay, if recoverable amount is greater than carrying amount, you can call it revaluation surplus. And if recoverable amount is less than carrying amount, you can call it impairment loss. This impairment loss is shown as an expense in SOPL. Okay, expense in SOPL. And if there is an impairment loss, the amount of impairment loss will be deducted from the existing carrying amount. What happens if the impairment loss is deducted from the carrying amount? We know that the equation is like this. PA minus RA equal to impairment loss. So what if PA is, if impairment loss is deducted from CA, you will be getting your recoverable amount. So in simple terms, we can say that we have to record an asset at its recoverable amount. Okay. Now we need to understand what is recoverable amount and what is carrying amount. Okay. We have two parts in the equation. Recoverable amount is there and carrying amount is there. In recoverable amount, you will be taking a higher of value, and in carrying amount you already know the equation as per carrying amount equal to cost minus accumulated depreciation. So here you have the calculation of recoverable amount. Recoverable amount is higher of these two values, fair value minus cost to sell and value in use. Okay, fair value is generally, you can say that it's a market value. From the market value, if you deduct whatever is the expected cost to sell, then you'll get a figure. Keep it there. And you need to calculate the value in use. Value in use is the present value of future cash inflows. Okay. So you are comparing this value in use and fair value minus cost to sell. Whatever is the highest figure, that is the maximum amount that you can expect to recover from this asset, isn't it? So the higher of fair value minus cost to sell and value in use, that is known as recoverable amount, and carrying amount equal to cost minus accumulated depreciation. When you compare this recoverable amount and carrying amount, if carrying amount is greater, then there will be impairment loss. After impairment loss, an asset will be shown in the SOFP at its recoverable amount. Okay, that is the concept, the basic concept of impairment loss. But you have a few more important things to consider in IAS 36. Basically, impairment loss is equal to carrying amount minus recoverable amount, where carrying amount is greater than recoverable amount. Recoverable amount equal to higher of fair value less cost to sell and value in use. Now, after impairment, the amount to be shown in SOFP equal to carrying amount minus impairment. That is simply the recoverable amount. From this recoverable amount, you will be deducting the depreciation also. Okay. That is the concept of impairment loss. Now, impairment is not regularly tested. It is something like you have to do it only if there is an indicator. Just note this. Impairment is tested only if there is an indicator. Test is conducted only if there is an indicator. You can go through your textbook. You have both internal and external indicators, which proves that the value of your asset is decreasing. Okay. If there is any indication that the value of your asset is declining, in that case, you will be doing an impairment review or an impairment test. Okay. So this impairment test is based on an indication. Sometimes, even if there is no indication, you will have to do the impairment review. What are the three assets that require an annual impairment review? Annual impairment review is required for goodwill acquired at business combination, then an intangible asset with an indefinite useful life. We'll discuss about intangible asset in the IAS 38. Then an intangible asset not yet available for use. These are the three assets that you need to calculate impairment annually. Every year you need to consider the impairment test, even if there is no indicator. IAS 36 requires annual impairment review for these assets, irrespective of whether there is any indication of impairment. Okay, all other assets like plant and machinery, equipments, all these assets will be revalued only if there is a specific indication. But these three assets will be regularly tested for impairments. Then the recoverable amount should be calculated and the asset should be written down at its recoverable amount. We already discussed this. The asset will be written down in the SOFP. The asset will be shown at its recoverable amount. And the impairment loss should be immediately recognized in SOPL. Now, one new point that you are learning here is the only exemption is to this is the impairment if the impairment reverses a previous gain taken to revaluation surplus. If you already have a revaluation surplus for this impaired asset, then first you need to set off this impairment loss with the existing revaluation surplus. Okay, in OCI under other comprehensive income. For the same asset, for example, you have a revaluation surplus of 5,000 and now you have an impairment loss of 8,000. In that case, first set off the impairment loss with revaluation surplus under OCI. Only the remaining value, the excess value over 5,000, what is that? 6, 7, 8. The remaining 3,000 will be taken to SOPL. Okay. So your first step is see whether there is an whether there is a revaluation surplus based on this asset. If there is a revaluation surplus based on this impaired asset, then the impairment loss is first set off under other comprehensive income with this revaluation surplus, and the remaining value is taken to SOPL. Okay, that is a highlight point that you need to keep in mind. In this case, an impairment will be taken first to revaluation surplus until the revaluation gain is fully exhausted and any excess is taken to statement of profit or loss. Then, reversal of impairment loss. You have already recorded an impairment loss, let's say 8,000. From our previous example, we had impairment loss 8,000. The calculation of impairment loss is based on predictions of what may happen in the future. Sometimes actual events turn to be better than predicted. Okay, we had indicators that the asset's value will be reducing. In that case, only we calculated this impairment loss. But suddenly, now actual event turns out to be the opposite. Okay, the value of the market value of our asset is now increased. If this happens, the recoverable amount is recalculated and the previous write down is reversed. Okay, so previous write down is reversed means it's not as simple as it seems. Previously, we recorded 8,000 as impairment expense. But when you're reversing it, it's not like simply you're recording an income of 8,000. It's not like that. You have a concept. A reversal of impairment loss is recognized immediately as an income in SOPL, but the amount of income to be shown. How to calculate the amount of income? Listen carefully. It's a very simple concept. The income to be shown in SOPL equal to the difference between the new carrying amount, difference between carrying amount of assets without considering previous impairments, without considering first impairments. Okay, you already recorded an impairment loss. That is the situation. You have already recorded an impairment loss. And now for the second time, when you are revaluing your asset, it seems like your asset is having a higher value. Okay, so when you had not considered this initial impairment from the cost, okay, from the purchase of the asset itself, you are calculating what would have been the carrying amount on this date. Just cost minus accumulated depreciation. You have no impairment to consider. Minus, you can say minus carrying amount by considering the first impairment. Okay, when you consider the first impairment situation, when you consider the impairment loss, what was the carrying amount? Okay, the difference between these two carrying amounts will be considered as an income, and this income will be taken to statement of profit or loss. Okay, so whenever there is a revaluation, always keep this concept in mind. whatever is the carrying amount, okay, we have already discussed the calculation of carrying amount in IA 16. Okay, as per IA 16, we know how to calculate the carrying amount of an asset. You need to calculate two carrying amount whenever there is a reversal of impairment. One carrying amount is without considering the first impairment, and the second carrying amount is by considering the first impairment. The difference between these two figures will be the amount of income to be taken to SOPL as reversal. Okay. An impairment loss recognized for goodwill can never be reversed. You also keep this point in mind. Whenever a goodwill impairment is reversed, that will never be recorded in the statements. It will not be recognized in the statements. Then, as part of IAS 36 itself, we have cash generating units, CGU. The smallest identifiable group of assets, you can say. Okay, you are forming a group of all assets in your company, and now this group is considered as a single individual asset capable of generating its own cash flow. Okay, so in this group, there can be building, plant, land, machinery, all those things can be included. This group of assets is now considered as a single asset. The impairment of a CGU is done by assuming that the cash generating unit is one asset and comparing the carrying amount of the CGU to the recoverable amount. So the total of the carrying amount of all these assets will be the total carrying amount, and the total of the what recoverable amount of all these assets will be total recoverable amount, and the difference will be total impairment loss. Now this total impairment loss must be allocated among all assets, isn't it? So this allocation has an order. I'll type it here. First, the allocation is to specifically impaired assets. Specifically impaired assets. Then, secondly, you will be providing it to the purchased goodwill. If your company has a goodwill, then the impairment is secondly allocated to the purchased goodwill. Then, thirdly, to all other assets on a pro rata basis. On pro rata basis. Okay, so this is the order of allocation. Specifically impaired asset means you might have undertaken any impairment review based on an indication. An internal or external indication must be there that the asset is reducing its value. So whatever asset led to this indication, whatever asset led to this impairment review, for that asset you will be allocating the maximum impairment. Then the remaining impairment will be secondly allocated to the goodwill until the goodwill is fully exhausted. Then even if there is any other remaining impairment, the remaining impairment amount is allocated to the remaining assets in the group based on pro rata basis. This is the allocation order. Okay. So that's all about IAS 36 impairment. Understand how to calculate recoverable amount, the higher of fair value minus cost to sell and value in use. And you will be comparing it with the carrying amount. The difference is considered as impairment loss. Impairment loss is taken to SOPL as an expense. Whenever there is a reversal of impairment, and income is shown in SOPL, which is the difference between carrying amount without considering impairment and carrying amount by considering impairment. Then, when you have a CGU, then based on this cash generating unit, you will have to calculate a total impairment, and this total impairment will be allocated in the following order. The order of allocation is important. First to specifically impaired asset, then to goodwill, and then to other assets. Okay, so that's all about IAS 36. You need to go through the indicators from your textbook. It's just a theory. What are the indicators? Internal indicators and external indicators. Yes. Our next standard is IFRS 5 non-current asset held for sale and discontinued operation. As per IFRS 5, we will be considering two different situations. No individual asset should be impaired below the recoverable amount means what? Where is it? No individual asset should be impaired below the recoverable amount. Yeah, it means it's based on the reversal. Where did you get this point from? What is it based on? From the textbook? Textbook, which topic? Is it under the reversal? CGU allocation. Under CGU allocation, what comes? No recoverable amount. No individual asset should be impaired below it. Oh, yes. So when you are showing a CGU, when you are calculating a cash generating units impairment, we have a tabular format. Let's say when you're answering, initially give the asset name, then you give the carrying amount of the asset, then the impairment, and when you deduct this impairment from the carrying amount, you will be getting the recoverable amount, isn't it? So when you are calculating the recoverable amount here, this allocation of impairment here, let's say the carrying amount was 5,000, carrying amount of an asset or specifically impaired asset is land. Okay, for example, just an example, land is the specifically impaired asset. In that case, we are looking the total impairment. The total impairment of the CGU is 1 million and the carrying amount of land is 100,000, or let's say it's 1,000, for example. And land has a recoverable amount of 1,500. If this is the case, you are not allowed to allocate this impairment above the impairment loss. Okay, sorry, if the recoverable amount, this is the case, 500. Okay, the recoverable amount of the asset is 1,500. Then you are not allowed to allocate the impairment above 1,000. Okay, even if the asset has a carrying amount here, whatever is the carrying amount, up to the carrying amount only you will be reversing. The recoverable amount also will be provided in the question. Up to the recoverable amount, when you deduct the carrying amount from the impairment loss, you will not be, impairment loss from the carrying amount, the actual amount will be 0, isn't it? The recoverable amount must be 0. But actually in the question it is given that the amount is 1,500. So in that case, what you can possibly do is, this land is not impaired. That is what you have to understand. And in the other situation also, the second situation that I was explaining, we have a recoverable amount of 5,000. Okay, if it's specifically mentioned in the question, the land is the specifically impaired asset. Okay, we knew that the land's value is decreasing. That's why we made this impairment loss. Okay, we tested this impairment. We conducted this impairment review. But land actually has a recoverable amount of 500. But if you are allocating impairment, you need to make sure that you are not allocating impairment at a value greater than this recoverable amount. So the maximum impairment allocation possible will be 500. Okay, then only the remaining value you will be getting as 500. If the recoverable amount of land is 600, then in that case, maximum allocation possible is how much? 400. If you deduct 400 impairment from carrying amount, then only you will be getting. Yes. Then only you will be getting 600 as recoverable amount. So the point is, first thing you keep in mind is, whatever is the maximum carrying amount, up to the maximum carrying amount, you can allocate the impairment. And secondly, you have to look whether the recoverable amount is given in the question. If a recoverable amount is given in the question, then you will be allocating a maximum of the remaining figure as impairment. So first, we don't want to allocate it, right? No. There will be no impairment. In the first case, it will be like the reverse. This is the first case, 1,500. And you have an impairment. Just if you are understanding the pattern only, you will be calculating as per the order. The allocation is 1,000. But if this happens, then what will be the recoverable amount? It will be 0, isn't it? But it's not possible. They already have a recoverable amount given in the question. It's 1,500. And since recoverable amount is greater than carrying amount, there won't be any depreciation, any impairment. So the impairment loss will be 0. The situation where impairment loss arises is carrying amount greater than recoverable amount. Okay. So in the second situation, you need to give more focus where there is impairment loss because recoverable amount is less than carrying amount. But as per the allocation order, if you are going on allocating maximum to the capital allowance, carrying amount, in that case, the maximum amount of allocation must be by preserving the recoverable amount. Okay, from the carrying amount, deduct the recoverable amount, the net amount will be the impairment. But this is only when the recoverable amount is given in the question. Usually in the question, only total recoverable amount will be given. They will not be giving you the individual recoverable amount of land, building, plant, and all. Okay, this is only a rare case. If the individual assets recoverable amount is given in the question, in that case, make sure that you are preserving this 500 and the remaining only will be the difference between carrying amount and recoverable amount will be the impairment loss. Okay, that's it. You cannot calculate the amount of impairment loss greater than the recoverable amount because you can already recover this from the market, 500. Then what is the point in allocating impairment loss of the amount greater than this amount? Okay. So that's it about impairment loss. Now you have IFRS 5, which looks into two concepts. First one is asset held for sale, and the second one is discontinued operation. For asset held for sale, you have 4 important conditions to be met. You need to learn these conditions. Theoretically, it is of some relevance. Okay. The asset must be available for immediate sale in its present condition. Then the asset must be sale must be highly probable. So to say that a sale is highly probable, you have again 3 sub-points. That is, the management must be committed to the plan to sell the asset. There must be an active program to locate a buyer. They will be advertising it or they will be doing something to locate the buyer. Then the asset is being actively marketed at a price that is reasonable. You cannot market an asset that at a price that you know nobody is going to pay. Okay, if you are marketing an asset whose actual value is 1 million, you are marketing it for let's say 10 million. So it's not possible to make a transfer. It's not possible to make a sales. So you need to make sure that it is marketed at a price that is reasonable. Then the sale is expected to be completed within 1 year. So when you are classifying an asset as held for sale, as on that date, your expectation will be you will be selling this asset within 1 year. That should be your expectation. And it is unlikely that significant changes to the plan will be made or that the plan will be withdrawn. You are not possibly withdrawing this plan or changing this plan. So if all these criteria are met, okay, if all these criteria are met, then we can classify a non-current asset as held for sale. If you classify a non-current asset as held for sale, what happens? What is the difference? For example, you had a machinery and you are classifying this machinery as held for sale as all the conditions are met. Once it is classified as as asset held for sale, then this non-current asset will now be shown as current asset in SOFP. Okay, usually machinery and all will be non-current asset, but once it's held as classified as held for sale, then it will be recorded under current asset and no more depreciation is calculated. Whatever is the depreciation till classification, that will be recorded in SOPL. After that, no depreciation is done on this asset held for sale. Now, what is the value to be shown as held for sale? It is the lower of carrying amount of the asset and fair value minus cost to sell. Just study this criteria. Carrying amount as on date of classification, then fair value minus cost to sell on that date. The lower amount will be taken to current assets as asset held for sale and it is not depreciated. So this is the treatment of asset classified as held for sale. You have the classification criteria. Measurement is based on this lower of condition. and its presentation is in SOFP under current assets. These are the three things that you need to keep in mind: recognition, measurement, and presentation. Then you have one more thing under IFRS 5 itself, that is regarding this discontinued operations. Okay. What is discontinued operations? This is the definition. A discontinued operation is a component of an entity that has either been disposed of or is classified as held for sale. And, okay, this is one part of the definition, and either of these two must also be met. And it represents a separate major line of business or geographical area, or it is a separate subsidiary acquired exclusively with a view for resale. If this definition is met, if you have a subsidiary which is held for resale, and if you are disposing one of your division, if you are shutting down one of your division which is capable of separate business, separate operation, in that case, you can classify this as a discontinued operation. Users can see the performance of remaining operations, enabling them to predict future performance more accurately. So, whatever we are doing this, why are we classifying this under IFRS 5? This classification will help the users to identify what profit or loss is from the discontinued operation and what is the profit or loss from the continuing operation. You can separately make judgments and analysis. So what is the amount to be shown based on discontinued operation? When you have a discontinued operation, an entity must disclose a single amount on the face of SOPL comprising the total of these two. You will be adding these two. What is it? First one is the post-tax profit or loss of discontinued operation. Profit is equal to income minus expense, isn't it? So the profit till the date of disposal. Okay. When you are disposing the asset on September, then from January to September, whatever is the profit earned by the company, whatever is the profit earned by this specific discontinued operation, that will be calculated separately. And you need to add the post-tax gain or loss recognized on the measurements. Okay, so it is simply, you can see like this: profit after tax from this discontinued operation plus profit, or you can say gain or loss on disposal or sales of discontinued operation. Okay, that's it. So when you add both these figures, profit after tax from discontinued operation plus gain or loss on disposal of discontinued operation, the total figure will be shown as a single line item in SOPL. Okay, the disposal of assets constituting discontinued operation. It must be shown as a single line item on the face of SOPL. Okay, you can say profit from discontinued operation. And in that profit from discontinued operation figure, you will be including the value of profit from discontinued operation, profit till the date of disposal, and gain or loss on disposal. When you add both these figures, the total amount will be shown in SOFP as profit from discontinued operation. You will not be separately including all incomes and expenses in the SOPL. That's it. So these are the treatments coming under IFRS 5. When an asset is held for sale and when an asset is discontinued, when there is a discontinued operation. Our next standard is IFRS 9, financial instruments. You need to understand that an instrument, a financial instrument, it is always a contract. So you might get some questions asking you to identify whether the following is a financial asset or financial liability, whether the following is a financial instrument. So before making sure that this is a financial asset, you have to see whether there is a contract or not. Only if there is a contract, then you can ensure that this is an asset. Then, as per this contract, financial instruments can be, there will be two parties in the contract, isn't it? For one party, this contract will be a financial asset, and for the other party, this contract will be a financial liability. Okay, we are talking about the same contract. Okay, so whoever has the right to receive something, for him, this contract is an asset. Now, as per the contract, if you have an obligation to make payment, then for you, this will be a financial liability. This is the highlight of this standard. A person who has right to receive something, for that person, this is a financial asset. And for a person who has an obligation to deliver payments, to make payment, for him, this will be a financial liability. Okay, so based on the same contract, somebody will be receiving something and somebody will be paying something. For the receiver, this is an asset, financial asset, and for the payer, this contract will be a financial liability. Then, let's discuss the treatment of financial liability first. Financial liabilities. Financial liability is initially recognized at its fair value. So what is the fair value? Here, the term meaning of fair value is different. Initial value or fair value is equal to cash received minus issuing cost. Can you give me some examples of financial liabilities for your company? What are the examples of financial liabilities? Yes, very good. A bond. When you are when you are issuing a bond, then anything else? Ashit, Hadi. Debentures, yes, but debentures usually for your international accounting, debentures are not well tested. But debentures is also issuing, debenture is also a part of financial liability. It is also a financial liability for you. Very good. Loan note and redeemable preference shares. These are very good examples. Okay. So, loan, when you are issuing loan notes, redeemable preference shares, bonds or debentures, whatever. So, these issuing, if you are the issuing company, then for you, these will be financial liabilities. So, when you are issuing a loan note, I'm taking the example of loan note. When you are issuing a loan note, then the initial value of this loan note, in the journal entry, the value of this loan note will be cash received minus issue cost. Whatever is the loan amount that you received, you are the issuer. You issued a loan note, and from the purchaser, from the investor, you received some money. So this cash received minus if there is an issue cost such as brokerage, commission, or anything like that, then this issuing cost will be deducted from the cash received. The net amount is known as initial value. So initial value or fair value of financial liability equal to cash received minus issue cost. Then subsequently, financial liabilities are measured at amortized cost. You have other model also, but it is not tested in financial reporting. In FR, just understand that financial liabilities will always be treated as per amortized cost model. Okay, for liabilities. For assets, you have all other models to learn, that is FVTOCA and FVTPL and all. But here, for liabilities, in financial reporting, you are basically following amortized cost model. As per this model, you have an equation to get the amortized cost or the final closing value. The final value will be initial value that we have calculated, cash received minus issue cost, initial value plus effective interest minus interest paid, that will be your closing value. Closing value. So this effective interest rate and your actual specific interest rate will be given in the question. Whatever is the interest rate, you will be calculating it. So how to calculate this effective interest? Keep in mind, effective interest is always calculated on initial value. Percentage is applied on initial value. This is where everybody goes wrong. And this interest paid, it is always calculated on nominal value. It is not calculated on initial value. It's calculated on the nominal value. That is the actual value of the instrument without deducting the issue cost and all on nominal value. Okay. So when you follow this equation, you will be getting the closing value of each year. So each year, whatever is the initial value, that will be recorded in the journal entry. Initial value will be part of your journal entry. Effective interest. Anybody? Where will you record this amount of effective interest? SOPL. Great. SOPL, finance cost. Okay. So effective interest will go to SOPL as finance cost. What about interest paid in which statement? Interest paid is just a cash outflow. So it is considered as a cash outflow in SOCF, statement of cash flows. It will not be recorded in SOPL. In SOPL, people get confused. This interest paid amount is shown in SOPL. No, the effective interest of this instrument is shown in SOPL, and the interest paid amount is shown in statement of cash flows. And whatever is the closing value that you get, that will be your non-current liability in SOFP. Okay, non-current liability. But in the last year, if your loan term is 5 years, then in the fourth year, the closing value that you are getting here, that will be your current liability. Okay, I'm giving you an example. Your loan term is 5 years. Then in the fourth year, the closing value that you get, that will be your current liability, because within 1 year, you are going to close this loan. And the fifth year closing value, you will be getting it as 0 always. Okay, so this is a simple method, but you can expect a question from IFRS 9 for about 99%. IFRS 9 is regularly tested for exams. You need to understand how to apply this amortized cost model and what all values will be taken to what all statements. In SOPL, effective interest will be taken, and this effective interest is calculated in the initial value upon the initial value. Then interest paid is taken to cash flow statement, and this is a percentage on the nominal value. And the closing value that you get, that will be taken to SOFP as non-current liability. Got it? Effective interest is on closing. You can say that effective interest on closing value, because initially effective interest, the first year's effect, if this is a 5-year loan, first effective interest will be calculated on the initial value. And in the second year, the effective interest will be calculated on the second year's opening value. We can say the second year's opening. This is year 2. In year 2, you have the opening value here. The opening value recorded here itself will be the first year's closing value, isn't it? So for the second year, for the first year, you will be calculating it on the initial value. For the second year, you will be calculating it on the opening value, and the opening value itself will be closing value. So yes, your answer is yes, correct. You are correct. As previous closing equals yes. So if you're telling it, you have to say that the effective interest is calculated on the opening value. The first year's effective interest is always calculated on the initial value. From the second year onwards, effective interest will be calculated on the opening value, and the opening value will be the closing value of the previous year. Good. Okay. I hope the concept is understood. Now we have compound instrument. The treatment of compound instrument is different. Compound instrument can also be called as convertible instrument. For convertible instruments, you follow split accounting, where in one financial instrument itself, you have a component of equity and liability, where there is a conversion option. For example, if I am issuing a loan note to Hadi, then for Hadi, I'm giving an option also. Okay, there is repayment. If you want Hadi, I can repay you in the form of my own shares, or I can repay you in the form of cash. So the option is to the lender. I'm giving the lender an option for the repayment, whether it's in the form of equity shares or in the form of cash. So it's his choice. Based on his choice, I have to record two elements. I have a liability element, and suddenly if he is asking me to issue my shares, then I have an equity element also. So when you are accounting for compound instruments, that accounting treatment is known as split accounting. And as for split accounting, let's see what is the initial value and subsequent value. Initially, the liability is measured at fair value. The fair value here is the present value of future cash flows. Future cash flows means we know the interest paid is the cash flow. Whatever is the amount of interest paid every year, the present value of this future cash flow will be considered as the initial value. And this is the initial value of liability. Okay, initial value of liability equal to initial value of liability equal to present value of interest payments. Okay, interest paid. What about equity? Present value equal to nominal value minus initial value of liability. Okay, so its equity element is just like the remaining value. Whatever is the remaining value after deducting the from the nominal value. If the nominal value is 1,000 and the initial value of liability element is 500, then the remaining 500 will be for equity. Okay. So the value of equity, the initial value and subsequent value will always be same. But the initial value of liability element will be present value of interest payments, and the subsequent value will be calculated using amortized cost model. Okay, so if the value of the loan note is 10,000, then you're splitting this 10,000 into liability value and equity value. Initially, you'll be calculating the amount of liability and the remaining will be allocated to equity. That is how you treat compound or convertible instruments. And this treatment is known as split accounting. Yes, interest paid is same for every year except the last year. Interest paid here in this amortized cost method, this interest payment every year will be same amount, but in the last year you will be including principal amount. If this is a 5-year loan, then in the 5th year this payment will be, this cash flow will be interest paid plus your redemption premium, like what premium value or your par value, whatever it is. If the redemption is at par, then par value plus interest for the last year. That will be the amount coming under this figure, under this column. Okay. Since it's applied on nominal value, every year this will be same. But since this effective interest is applied on the initial or opening value, every year effective interest will be changing. Now, when it comes to the subsequent measurement of compound instruments, the compound instrument is also subsequently measured at amortized cost and the liability elements. Okay, keep in mind the liability element of compound instrument is measured at amortized cost. Amortized cost is equal to initial value plus market interest minus interest paid. Okay, and I already discussed that the equity element, whatever is the initial value that you have calculated, the equity element is not remeasured and it remains the same value on the statement of financial position until the debt is redeemed. Okay, so equity, the initial value itself will be the subsequent value, and for liability, from the initial value, you will be calculating the closing value using amortized cost model. Initial value plus market rate of interest means effective interest itself minus interest paid. Okay, everything is similar to what we discussed regarding financial liability. When there is a compound instrument, a liability element is subsequently measured using amortized cost model, and the equity, for the equity, the initial value itself will be the subsequent value. That is regarding compound instruments. Next, we have financial assets. To measure financial asset, you have the three models. So initially, let's see what are the classification of financial assets. Financial asset can be equity instrument or debt instrument. If you are investing in another company's shares, then you can say that this is an equity instrument. If you are investing or purchasing some other company's loan note or bond, then that will be a financial asset, but it's a debt instrument. Okay. So financial asset can be classified into equity instrument and debt instrument. Equity instrument means if you are investing in shares of another company, and debt instrument means if you are investing in the bonds or loan note of another company. Investment means you are purchasing, you are the purchaser. Okay. So first, let's see the treatment of equity investment. You have two options for equity investment. The first one is FVTPL and the second one is FVTOCI. If you are following fair value through profit or loss, this is the default category. This is the default model, and this model is chosen when your intention is short-term trading. Your intention is short-term trading. You are intending to sell this asset as soon as possible. Okay. Then, when you're following FVTPL, then the transaction cost or the brokerage commission, all those issue costs are expensed to profit or loss account. They cannot be capitalized. Then the investment are then revalued to fair value. Every year, you will be calculating the fair value of this asset, this share. So what is the market value of this share? Every year, you will be cross-checking. And the gain or loss from the date of purchase till the revaluation date, if there is a gain or loss, that will be taken directly to SOPL. So if you are following FVTPL, this is the default model and the company's intention will be short-term trading. Then if you are following FVTPL, all transaction costs will be expensed to SOPL and the gain or loss will be transferred to SOPL. Now, when you are following fair value through other comprehensive income, FVTPL means fair value through profit or loss. Now, the second model is FVTOCI, that is fair value through other comprehensive income. If you are following FVTOCI, this is usually done when your intention is long term. Okay. When you are planning to hold this for a long term, hold this asset for a long term, then you will be choosing fair value through other comprehensive income. It can only be done if the investment is intended as a long term investment. Once designated, this category cannot later be changed into FVTPL. In this case, transaction cost will be capitalized. If you choose FVTPL, transaction cost is expense, and if you choose FVTOCI, transaction cost is capitalized. The investments are revalued to fair value each year and with any gain or loss taken to OCI. In FVTPL, gain or loss was taken to SOPL. But if you are following FVTOCI, then the gain or loss is taken to OCI, other comprehensive income. If a fair value through other comprehensive income investment is sold, the investment reserve can be transferred to retained earnings or left in equity. So your intention is long-term trading or holding, isn't it? So when you are disposing this on a future date, when you are selling the shares on a future date, at that time, your investment that you have included as in the reserve, whatever you have included in the reserves, it can be transferred to the retained earnings. Reserves means OCI. In the other comprehensive income, whatever amount you have recorded, this other comprehensive income value, this revaluation surplus will be transferred to retained earnings, or you can keep it there in the equity itself, in revaluation surplus itself. No issues. Okay, but it's better to transfer from revaluation surplus to retained earnings. When you're following FVT OCI, you will be capitalizing transaction costs. Gain or loss will be taken to other comprehensive income. And when you're selling this FVT OCI held instrument, then on disposal, you will be calculating, you will be taking this OCI figure, whatever is based on this instrument, whatever is taken to other comprehensive income, that figure will be transferred to retained earnings. These are the adjustments regarding fair value through other comprehensive income. Now, when it comes to debt instruments, you have three models. Okay. Can you tell me what are the three models for debt instrument? Now we discussed equity instrument. For equity instrument, you have two models, FVTPL and FVTOCI. What about debt investment? Which all models can you follow? Very good. You can follow FVTPL, FVTOCI, and amortized cost model. There are three options. Fair value through profit or loss, fair value through other comprehensive income, and amortized cost model, ACM. So how will you choose which among this must be followed? How can you choose the method? This choice will be made based on two tests, that is business model test and contractual cash flow test. As per business model test, you are checking the objective of the instrument, whether your objective is short-term trading, long-term holding, or whether you are confused. You don't know whether to sell it or you will hold it till maturity. You are confused. So these are the three options. So here you are, as per business model test, you are checking the objective or the intention of purchasing this instrument. Then, as per contractual cash flow test, this test checks whether the contractual terms of the financial asset give rise to cash flows that are solely payments of principal and interest. Okay, so here you are checking whether this is a compound instrument or not. Or not. If it's a compound instrument, then the contractual cash flow test will be a fail. If it's a compound instrument, contractual cash flow test is fail. If it's not a compound instrument, that is, your payment will be only in the form of cash. You are paying interest in the form of cash. You are repaying in the form of cash. Repayment is not in the form of equity. So if there is a compound instrument, then contractual cash flow test is fail. Then if it's not a compound instrument, then contractual cash flow test is pass. So based on these two test results, you will be deciding which method to follow. You have to learn this table. If your intention is to hold till maturity and your contractual cash flow test is passed, in that case, you will be following amortized cost model. Then if your intention is hold and sell, you will be holding for 1 or 2 years and after that you will be selling it. Okay, you are not holding it till maturity. In that case, and if the contractual cash flow test is passed, in this case you will be following fair value through other comprehensive income. In all other situations which doesn't meet this criteria, we are considering fair value through profit or loss, FVTPL. That is, if contractual cash flow test is a fail, you follow FVTPL. If your intention is short-term trading, then also you follow FVTPL. Okay, so these are the two situations where you follow amortized cost model and FVTPL, FVTOCI. If contractual cash flow test is passed and your intention is holding till maturity, you follow amortized cost model. If contractual cash flow test is passed and your intention is to hold and sell, then you follow FVTOCI. In all other situations, you will be following fair value through profit or loss. So that's all about IFRS 9. You have two main classifications, financial asset and financial liability. And you have compound instruments where you have to split accounting. Do split accounting. You split between equity and liability. And in all these models, you already know what is FVTPL, FVTOCI, and amortized cost model. Now let's see what is the treatment of assets in using these models. We learned FVTOCI and FVTPL based on equity. We learned amortized cost model in financial liability. Now, how can we incorporate this in debt investments? The measurement of debt investments. Initially, if you are following FVTPL, you will be measuring the initial value of the instrument will be at fair value, that is at the nominal value itself, and the transaction cost will be transaction cost will be expensed to SOPL. Subsequently, every year you need to recalculate the fair value, and the difference between these two fair values will be the gain or loss taken to SOPL. Okay, so this is very much similar to the equity instrument itself. Then, when you are following amortized cost model, there is a small change in your format or your formula. That is, here, pro forma for subsequent measurement, look here first. Subsequently, we know amortized cost model has an equation. Initial value plus effective interest minus interest paid. But here, when it comes to assets, amortized cost will be opening balance or initial value plus effective interest, interest income means effective interest itself, minus interest received, okay, payment received or interest received. So I'll repeat it once again, initial value plus effective interest income minus interest received, that is the balance carried forward. So here, this balance carried forward will be your SOFP value. Then interest payment will be your cash, interest received will be your cash inflow, SOCF. Then interest income will be SOPL figure, that is an investment income. And this opening will not be shown anywhere. It's the first initial value to be shown in journal entry. The recording will not be directly provided. We will be uploading it in the YouTube. Okay, you can get access in the YouTube. Okay, Aman? Yes. Okay, so this is about amortized cost model for debt instruments. If you are following amortized cost model to account for debt instruments under financial asset. Okay, so for that financial asset, this SOFP, this closing value that you get, that will be shown as non-current asset. Okay, this will be non-current asset. And in the second last year, that is if your instruments validity is 5 years, then in the fourth year, you will have a current asset, just like the liability, but here you have non-current assets. And initially, you will be capitalizing whatever transaction cost is there. That is, if there is an issue cost, you will be capitalizing the value and it will be shown in SOFP. Subsequently, you will be following amortized cost model. You will be following this equation and calculating whatever value that you are required to do. If you need the SOPL figure, then the investment income, the interest income will be the effective interest rate on the opening value. Then, if you are required to calculate the SOFP non-current asset value, then it can be also calculated using the amortized cost model. The closing value will be taken to SOFP. So that's all about IFRS 9. Now our next one is IAS 21 foreign currency. Whenever your company has a foreign transaction, whenever there is an overseas customer or an overseas supplier, in that case, you will be following IAS 21 rules. There are 3 rates, okay, exchange rates. The first one is historic rate or spot rate. When you buy the asset or when you sell the asset, on that particular date, what is the exchange rate between these two countries prevailing? That will be given in the question. That is spot rate or historic rate. Then, on the year end, when you are preparing the statement, what is the rate, exchange rate prevailing on that date? That is closing rate. And you also have average rate, that is the average exchange rate throughout the accounting period. That is not tested in financial reporting. Don't worry about this. You only need 2 rates, that is historic rate, the date of transaction, and the closing rate, that is at the reporting date. These are the 2 rates that we need for calculation. Now we have 2 currencies, functional currency and presentation currency. You only need to understand the meaning. The currency of majority transactions, okay? The majority transactions is happening in which currency? That is known as functional currency. And the currency in which the financial statements are presented, that is the presentation currency. Maybe if for 2 marks, if something regarding functional and presentation currency comes, you need to know what is functional currency and what is presentation currency. Then, before going into the initial and subsequent treatment of assets and liabilities, you need to classify them as monetary items and non-monetary items. Monetary items means items that can be easily convertible into cash. items that are easily converted into cash. For example, receivables, payables, and loans. It need not always be asset. Monetary liabilities can also be there. So these easily convertible into cash, whatever assets or liabilities are there, that are monetary items. And there can also be non-monetary items that give no right to receive or deliver cash. For example, inventory, plant, and machinery. So these are assets which do not give rise to immediate cash receipt or payment, isn't it? So such items which are not easily convertible into cash, that are known as non-monetary items. Now, our treatment as per IAS 21 will be based on this classification. Initially, both monetary and non-monetary items will be translated at spot rate. So when you are purchasing an asset, let's say a non-monetary asset on 1st April, then on that date, whatever is the exchange rate prevailing, you will be translating it using that spot rate. And another example is, if you are purchasing inventory is a monetary item. If you are purchasing an inventory from an overseas customer, at that date also you will be translating this invoiced value at its spot rate, the prevailing historic rate. Then, subsequently, for monetary items, you have to see whether settlement is made during the year and whether settlement is not made during the year. If settlement is made during the year, then whatever is the settlement date, you have to retranslate it. Retranslate using spot rates as on settlement date. Then, what happens if settlement is not made during the year? If settlement is not made during the year, then it is retranslated at closing rate. That is, when you are preparing the statement, if, for example, on 31st December, if you are preparing the statement, on that date, you will be retranslating, okay, at closing rate. Okay, so for monetary items, initially translated at the spot rate. Subsequently, you have to see whether settlement is made during the year or settlement is not made during the year. If settlement is made during the year, then it is retranslated. Subsequently, it is retranslated at the rate, spot rate on the settlement date. And if it's not settled during the year, then it is retranslated using the closing rate. Okay. The next treatment is for non-monetary items. They are initially translated at historic rate and carried forward at its value, at its carrying value or revalued amount. If the company is following revaluation model, then you will be revaluing the asset at the year end, and the revalued amount is translated using the spot rate. Okay, and if it's not a revalued amount, then you need not calculate any subsequent value. The initial value itself will be the subsequent value, but you need to deduct the depreciation. Since it's a non-monetary item, if it is, for example, if it is a, what to say, this asset, machinery or plants, in that case, you have to do depreciation on this initial value. That is the only thing to do, but no retranslation is happening. Whenever there is a non-monetary item, you don't need to retranslate it. You only have to depreciate it if it's a non-current asset. In the year end, in case of both monetary and monetary items, the difference between the initial and subsequent value will be considered as gain or loss. And this gain or loss will be taken to SOPL as foreign exchange gain or loss. Got it? So initially translate it at spot rate. Subsequently, you have to see whether it's monetary or non-monetary. If it's monetary, see whether it's settled during the year or not during the year. And based on that, you will be calculating the subsequent value. Now, whatever is the difference between initial and subsequent value, that will be taken to SOPL as gain or loss. This is the rule for IAS 21, foreign currency. Next is IAS 12, income tax. In income tax, you have to learn about current tax and deferred tax. These are the two classifications, PT, liability. current tax liability, which is, as the name suggests, it is a current liability. And you also have deferred tax liability, which is a non-current liability. Okay, so these are the two main headings that you have to come across in IAS 12. Current tax provision. Current tax, the only thing you need to understand is current tax is only an estimated figure. Okay, it is not the actual amount that you will have to pay. This is based on estimates. Whatever is the estimated value for your tax for the current year, that estimated figure is known as current tax. And this current tax can be calculated as a percentage of taxable profit. So if I'm giving an equation, it will be like taxable profit into tax rate. Okay. When you apply this equation, you will be getting current tax estimate. Okay. Or current tax provision. Your journal entry is debit income tax expense. You will be recording this value in SOPL and the same value will be taken as a current liability in SOFP. And what is taxable profit? The profit that is calculated based on tax rules, that is taxable profit. Okay. So that's about current tax. Now, you need to understand what is under provision and over provision. Since current tax is an estimated figure, it is not always necessary that the current tax amount itself will be the actual amount of tax payable. So, if eventually actual payment is less than the estimated figure, you need the previous slide. Is it done? Yes. We have both under and over provision. If your actual liability is greater than, if actual is greater than estimate, then in that case, what can you call it? Is it overestimation or underestimation? Yes, it is underestimation. Underestimation. Actually, your liability was 10,000, but you estimated only 8,000. In that case, you need to create an under provision. Under provision. And the opposite will be over provision. So it's like your actual amount that you are expecting is less than, actual amount was less than estimate. In that case, you will be recording over provision. This is overestimation. Okay. So this is about under and over provision. Now, if you have an under provision, then this under provision will be added to the current tax. Okay. Tax. And if you have an over provision, then this over provision will be deducted from current tax. Okay. When you are calculating the income tax expense, you will be required to calculate the income tax expense to be shown in SOPL. So if you are calculating the tax,
Previous year will be added, and over provision, if there is an over provision, it will be deducted. For an essay question, in the trial balance, figure will be provided. Trial balance, if in the you have two columns, debit and credit columns. If your amount of tax is under debit column, then you assume that this is under provision. Okay, in the trial balance, you'll be getting the opening figures. So, if it is having a credit balance, then assume that it is previous year's over provision amount. Okay, this is for essay question. If in the essay question, they are asking you to prepare SOPL or SOFP and they have given you a trial balance. In the trial balance, if the amount of tax is in debit side, then it represents under provision. And if the amount is in credit side, then it represents over provision. Got it? Yes. Then next is deferred tax provision. Deferred tax is the estimated future tax. Okay, deferred, the term meaning deferred itself is something regarding future. You are making a payment in future means that is deferred payment. Okay, so that like that, this is deferred deferred provision where the assets, where the tax liability is deferred. You are not paying the tax now, but you know that on a future date you will incur tax on this figure. Okay, so this deferred tax arises only when there is temporary difference, and this difference is between taxable profit and accounting profit. Accounting profit is calculated by companies based on accounting rules and principles, and taxable profit is calculated by the tax authority for the company based on tax rules. Okay, so there will be a difference between tax rules and accounting rules, and hence this will lead to a difference in taxable profit and accounting profit of the same company. If these are permanent differences, you have to go through what is permanent difference. If there is permanent difference, then you will not be calculating deferred tax. Instead, you will be simply adding back all those disallowed expenses. Some expenses, this tax authority will not be allowing you to deduct. For example, fines, penalties, and all. You will be deducting it from your SOPL. Okay, you in the sense company. Company will be deducting it from the SOPL, but tax authority is not permitting it. So this disallowed expenses you will be adding back. That is the only adjustment for permanent differences. But there are some temporary differences where in this case, you will have to calculate a deferred tax on this temporary difference. Okay, let's see what are the temporary difference and how to calculate a deferred tax provision. The main reasons for temporary differences are, one is short-term timing difference. It arises mainly because of the difference in tax computation under accrual basis and cash basis. So tax authorities, they usually follow cash basis, and companies, they follow accrual basis of accounting. So due to this change in basis of accounting, they will have a short-term timing difference. If today you are not paying tax on this profit, tomorrow when the cash is actually paid, HMRC will also be considering that as taxable profit. Okay, so that creates only a temporary difference based on cash basis followed by tax authority and accrual basis followed by company. And there can also be one more reason, that is accelerated capital allowance. So just understand that I'm not going deep in this concept because you have a lot to learn. So the thing is, instead of depreciation expense, tax authority or as per tax rules, they are permitting you something called capital allowance or tax allowance. Okay, so the company have calculated depreciation using reducing balance method or straight line method, and you have deducted this as an expense. But tax authority is not permitting you to deduct this depreciation as an expense. This is a disallowed expense. But instead of this depreciation, they are giving a similar item called capital allowance. That will be given in the question itself. You don't need to calculate capital allowance and all. But understand that due to this difference also, there can be a temporary difference arising. Now, whenever there is a taxable temporary difference or deductible temporary difference, you have to calculate deferred tax. Now, let's see what is taxable temporary difference and deductible temporary difference. If carrying value of an asset, that is the carrying value calculated by company, if it's greater than the tax base of an asset, what is tax base? Tax base is the carrying amount calculated by tax authority. Okay. So if the carrying amount calculated by the company is greater than the carrying amount calculated by tax authority, in that case, the difference between these two, carrying amount and tax base, you can call it taxable temporary difference. And this difference, when you multiply this difference with the tax rate, you will be getting deferred tax liability. Whatever is the tax rate, you will be applying it. So you will get a deferred tax liability, and this deferred tax liability is a non-current liability. Got it? Then, if the carrying amount calculated by the company is less than the tax base, that is the carrying amount calculated by tax authority, then the difference is known as deductible temporary difference. And when you apply a percentage on deductible temporary difference, the tax percentage into deductible temporary difference is equal to deferred tax asset, and this is recorded as a non-current asset in SOPL. Non-current asset in SOPL. Okay. And one more thing that you have to note it, deferred tax arising on revaluation surplus. If an asset has revaluation surplus, whatever is the figure in the other comprehensive income based on revaluation surplus, on this revaluation surplus, you will be multiplying this tax rate, and there will be deferred tax on revaluation surplus. It will be added to the deferred tax calculation. To the total deferred tax value, you will be adding this revaluation deferred tax on revaluation gain. This means that the deferred tax related to revaluation gain should be recorded in OCI. That is, if we there is 10,000 revaluation surplus in OCI and 10% is the tax rate. In that case, 10% on 10,000 will be 1,000, and this 1,000 is deferred tax liability. This will be deducted directly from the overall 1,000, overall 10,000, and the remaining 9,000 will be taken, will be shown under other comprehensive income. So always understand that whenever there is revaluation gain, on this revaluation gain, you will be multiplying a tax rate and you will be calculating deferred tax on revaluation surplus. Got it? So that is all about IAS 12 income tax. And this format, this is very, very important. You need to learn this format. In SOPL, they will be asking you what amount is to be shown in SOPL as income tax expense. Amount to be shown in SOPL is equal to current tax plus under provision minus over provision, means there will be either under or over provision. If there is under provision, you will be adding it. If there is over provision, you will be deducting it. And the increase or decrease in deferred tax liability, you will be checking the difference between opening and closing deferred tax liability. Whatever is the difference amount, this increase or decrease, it will be the balancing figure. It will be taken to the income tax expense calculation. Okay. So increase in deferred tax liability will be added and decrease in deferred tax liability will be deducted. So simply you can say that the aggregate total of current tax, then plus or minus under or over provision, plus or minus increase or decrease in deferred tax liability equal to tax expense to be shown in SOPL. Okay, and this deferred tax closing balance, this will be the non-current liability in SOFP. This current tax will be the current liability in SOFP. Got it? This format is very, very important. If you understand this format, if you have this format in your mind, you can score full marks from IAS 12. So it's actually 8 o'clock. We have few more topics left. I think we will possibly cover the standards today. And for consolidation, along with the question, I'll be teaching you the essay question. I'm teaching you essay question, isn't it? So along with this essay question solving, we can discuss what are the working notes in consolidation, and likewise interpretation also. We can study the concept along with the essay question, 20-mark question. Okay. So today we can possibly complete this IAS 2. Sorry, the standards, international accounting standards and International Financial Reporting Standards. Let's take half an hour more. Cash flow also through the question. I'm also planning to do a cash flow statement preparation question. So tomorrow's plan will be like this. We'll do a cash flow question, 20-mark question. We'll understand the entire concept of cash flow through that full question. Then we will prepare a consolidated statement, and through this consolidated statement, we'll understand the entire concept of consolidated statement. Then we will also do analysis and interpretation question, where you will cover those topics of ratio analysis. And I'll teach you how to use your MyACCA account. If this is for your first time, that will be beneficial for you. So many students have requested me to show this usage of practice platform and all. So we can keep this as a plan for tomorrow. Today, let's complete all standards. Actually, Arsh, you cannot expect a complete cash flow statement preparation. It is given in your textbook itself, and ACCA is also provided instructions. In your MyACCA account, you can see that cash flow statement as a whole, a full-fledged preparation question will not be coming. But in a 20-mark question, you can expect like partial preparation. Okay, you are preparing cash flow statement in 2 parts. Maybe the first part they will be asking you. Okay, so partially you can expect in the past exam, in previous year September exam, my friend appeared and he got this cash flow statement for his 20-mark question. But it was not cash flow preparation. There were like sub questions, section like A question for 5 marks to calculate cash generated from operation, B question to calculate this analysis and all those things. It was not a full-fledged preparation question. Okay, preparation will not be coming, but conceptually, you can expect questions both in section A and C. Single entity question, it will be based on the timing, or else I can share my recorded videos. I have recorded this single entity question solving. If possible, after completing consolidation and preparing consolidated statement, after completing SOCF and preparing SOCF, and after completing interpretation, if you have time, we will be preparing a single entity statement. Otherwise, I'll teach you how to prepare and I'll be sharing you the recorded video link. Okay? Ashiyat? Yes. Section C questions only. Section A and B is like, we cannot do revision for all those parts. You have to do it yourself. If you are texting me personally, I'll be sharing you my PPT. In this PPT, from every concept, I have included 2-mark questions. That is section A questions. So you can go through those questions. Practice it yourself and approach your faculty if you have any doubt. Okay? Yes. So let's continue with the standards. We have few more standards remaining. IAS 2, in IAS 2 inventory, you have nothing much but to understand the concept. As per IAS 2 inventory, the value of closing inventory to be shown in SOFP. Closing inventory in SOFP. Inventory is a current asset, isn't it? So current asset, the amount will be lower of cost or NRV. This is the only concept that you need to understand. Lower of cost or net realizable value. Okay. So if cost is lower, then the cost of the inventory will be taken to SOFP. If net realizable value is lower, then that amount will be shown in SOFP. So what is cost and what is net realizable value? You only have to understand that. No, this is the simplest standard that I can find in financial reporting. Cost is simply the cost of completion. Okay, you can say cost is equal to cost of completion. Cost of completion equal to cost of purchase plus cost of conversion. So all direct expenses that you incur in completion of this inventory to bring it to its usable form, what all are the expenses? That is considered as cost of completion. you will be comparing it with the net realizable value. You can go through this excluded cost, this abnormal waste, storage, general administrative overhead, all and selling cost. These are the excluded cost. All other costs based on the completion of this inventory will be included in the amount of cost. Now, what is net realizable value? NRV is equal to selling price minus cost to sell. Net realizable value equal to selling price less cost to sell. Okay. And for subsequent valuation of cost, you have three models: FIFO, average costing, and actual unit cost. You need to understand the terms only. The calculation part, it is coming in financial accounting, F3. Okay. In FR, you don't have to have the knowledge of this, how to calculate using FIFO basis, how to calculate using average costing. It's not usually tested. Okay. So there are three methods for calculating the cost. Understand that cost is the overall direct cost incurred to complete the product. The net realizable value equal to selling price minus cost to sell. When you compare both these figures, you will be getting the lower, and the lower amount will be taken to SOFP as current asset. As current asset inventory. That's all about IAS 2. Then you have IAS 41 agriculture. Under agriculture itself, you have two subheadings, that is biological asset and agricultural produce. Biological asset means any living animal or plant such as dairy cattle, pigs, sheep, cotton plant, sugarcane, etc. So for all these biological assets, initially you will be recording it at its fair value. Okay, initial measurement means to record it in the journal entry. Initial value will be at its fair value. If no fair value is given, then you will be using cost model. Okay, always this cost model thing will not be tested generally, but understand that if fair value is not given, then you will be following cost model. Then subsequently, these assets like cattle, pigs, sheep, these biological assets, they will be revalued to fair value less cost of sales. So whatever is the fair value minus cost of sales, that will be taken to SOFP. Fair value minus cost of sales, that is taken to SOFP, and whatever is the difference between the initial value and subsequent value, this gain or loss will be taken to SOPL. Okay, initially measure it at fair value on the purchase date. Subsequently, again measure the fair value at the reporting date. So the difference between the initial fair value and the subsequent fair value will be the gain or loss to be taken to SOPL. And the year-end fair value minus cost to sell will be the value to be shown in SOFP. This is the treatment of biological assets. Next, you have agricultural produce. Agricultural produce is the output from biological assets such as milk, wool, picked leaves, fruits, etc. And this name, agricultural produce, this name is only for one day. Initially, at the date of harvest, the produce should be recognized and measured at fair value less estimated cost to sell. Okay, so initially, fair value minus cost to sell, that will be the value of agricultural produce. From the second day onwards, note my word, from the second day after harvesting, this turns out to be a part of your inventory, IAS 2. Okay, it ceases to be a part of IAS 41 and it becomes a part of IAS 2 inventory. Okay, subsequently, after harvesting, IAS 41 ceases to apply. Agricultural produce becomes an item of inventory. The fair value less cost to sell at that point of harvest is taken as cost for the purpose of inventory. So, inventory, how do you value inventory? Lower of cost or net realizable value, isn't it? But for this inventory, this milk, wool, this we have no cost. We acquired it, we harvested it from our own biological asset, isn't it? So what will be the cost for the purpose of IAS 2 treatment? Cost will be fair value on the date of harvest. Okay, fair value at the date of harvest will be cost for IAS 2 accounting purpose. As per IAS 2, lower of cost or NRV will be considered. But these agricultural produce that turned into inventory, they don't have an actual cost. So the fair value at the date of harvest will be cost for the purpose of IAS 2 accounting as inventories. Got it? So these are the treatments coming under IAS 41, biological assets and agricultural produce. Next is IAS 8, accounting policies, changes in accounting estimate and errors. So these are just theory. I think you can read this. We are looking into accounting policies, accounting estimates and errors. Whatever is given in the question, that it's in the textbook, I've taken that here. I'll just briefly go across these three topics. Okay, you have to do your part. You have to read this. This is completely theory. You don't have a criteria for calculation and all. The first heading is accounting policies. If you have an accounting policy, you will be asked to check whether this is a change in accounting policy or not. So if you need to identify a change in accounting policy, then you need to make sure that this is a change in the recognition, presentation, or measurement. If the change is either in a change of these three, then you can say that this is a change in accounting policy. Okay, accounting policy can only be changed when it's required by an IFRS or if it results in a more reliable or relevant information. We discussed it in IA 16, this concept, isn't it? So here, a change in accounting policy is identified. How can you identify whether this is a change in accounting policy or not? See whether this is a change in recognition, presentation, or measurement. For example, if there is a change in an expense, now whatever we showed as an expense in the statement is now recognized as an asset. In that case, this is a change in recognition criteria. So this is a change in accounting policy. Now, a change in presentation. Depreciation is generally included in administrative expense, but now we are showing it in cost of sales. In that case, this is a change in presentation. That is also a change in accounting policy. Now, measurement basis. If you are following like replacement cost rather than historic cost, okay, you are following current cost rather than historic cost. In that case, you are having a change in measurement basis. This also represents a change in accounting policy. So whenever there is a change in accounting policy, what will you do? How will you account it? The accounting treatment of accounting policy, it is done retrospectively. Retrospectively means this change is incorporated in the previous year's statement also. Okay, so that is the point, the keyword that you need to keep in mind. The change in accounting policy has a retrospective effect in the statement. It affects the previous year's statement also for facilitating comparison. That's it about accounting policy. Now you have accounting estimate. Accounting estimate means we have lots of calculations in our statement based on estimate, isn't it? So we are, for example, we are calculating depreciation based on estimate. We are calculating this useful life and all. That is based on the estimated, the expectation, isn't it? So whatever is the estimates, if you are making a change in your estimate, then that is known as accounting estimates. So you calculate depreciation based on estimate, which means if your depreciation value changes, your method of depreciation changes, then that is a change in accounting estimate. Then your fair value of asset or liability. You are calculating provision, for example. Provision is calculated based on estimated figures. Okay, provision is created for future. As per IAS 37, we'll discuss regarding provision. So, for a future value, we are calculating it based on our estimate. So, this is also a change in accounting estimate. Then, net realizable value of inventory is also based on the expected selling cost and all, fair value, selling price minus cost to sell. That is only an expectation. We are not sure that on the next day, if we can acquire this, if we can sell this inventory at this particular value itself. So anything that you have calculated using expected values, that value change is a change in accounting estimate. And when there is a change in accounting estimate, you will be recording it prospectively. Okay. Accounting policy change is accounted retrospectively, and accounting estimate change is only accounted prospectively. What is the term meaning of prospectively? Which means it is considered only from the current date. Okay, from the current statement. In the future statements only, we will be considering these changes. Okay, in the previous statement, you are not making any editing. That is prospective change. Okay, so accounting policy change is retrospective and accounting estimate change as prospective. Yes, very good. Affects present and future value. It does not affect the past. Very good, Ashir. Then we have one more topic here, that is prior period errors. When you find a prior period error, that also have a retrospective effect. You need to go back and correct it. Okay, whenever you find a mistake, that mistake can be mathematical errors or omissions, whatever. If you find a prior period error, you will be correcting it. It also have a retrospective effect. Okay. And if current period errors are discovered in that period, it should be corrected before the financial statements are authorized for issue. So before authorization, even after preparation, if you find an issue in your current statement, before authorizing it, before authorization for issue, you will be correcting this error. That is retrospective effect for prior period errors. And for current period also, whenever you find the mistake, you will be correcting it on a retrospective basis. So for change in accounting policy, you have retrospective effect, and change in prior period error also you have retrospective effect. And for change in accounting estimate, you have a prospective effect. That's all that you have to understand the key terms here as per IAS 8. Now we have IAS 38 intangible assets. This is very much similar to the tangible assets. I'll take you to the focus area. Initially, it is measured at cost. Subsequently, you have choice between cost model and revaluation model. So this is exactly same as IAS 16 that we learned. We took so much time and we learned. And here, if you choose cost model, this is the most commonly used model for IFRS, for IAS 38, intangible asset, because you don't get the market value of intangible assets like patents, copyright and all. Okay, so since the market value cannot be determined easily, you can follow the commonly followed model is cost model. As per cost model, carrying amount equal to cost minus accumulated amortization. We have discussed grant amortization. Grant amortization is an income. But when it comes to the amortization of intangible assets, this is an expense, just as depreciation. Instead of depreciation, we are calculating amortization. So as per cost model, we will be calculating the carrying amount. And there are assets with definite useful life and finite useful life and indefinite useful life. You can calculate amortization only when you know the useful life. Otherwise, amortization will not be calculated. Then, if you follow revaluation model, just as I discussed, you don't have an active market. Since there is no active market, it is hard to get the fair value. If you cannot get the fair value, then how can you follow fair revaluation model? So that is why revaluation model is rarely used. As per revaluation model, carrying amount equal to revalued amount minus accumulated amortization. But revaluation model is very rarely followed because you don't have an active market for so many intangible assets like patent, brand, trademarks, etc. Okay, most of intangible assets will not have active market. So it is very rare to follow revaluation model. Then, goodwill is also an intangible asset, but in the statement, you will only show purchased goodwill. At the time of acquisition, if there is a goodwill, that goodwill only will be shown in SOPL. The non-purchased goodwill or inherent goodwill will not be shown in SOFP. Okay, this is not a non-current asset. Only purchased goodwill is taken to SOFP. Then you have a new heading, research and development. You know what is research and development? Research means any study conducted for gaining new knowledge. And development means based on this new knowledge, based on this new scientific knowledge, we are developing, we are inventing a new thing, that is development. So the cost relating to development and research, how can we show that? How to include it in the statements? A research expenditure, we just write it off as incurred as a normal expenditure in SOPL. But the development expenditure, you have to decide between whether it need to be shown in SOPL or SOFP. If all these 6 criteria are met, you have to capitalize the development expenditure. That is, if the conditions are met, then development expenditure is shown in SOFP. Otherwise, development expenditure is shown in SOPL. Okay. So here you have pirate criteria. Probable flow of economic benefit. Then there must be an intention to complete this project. Thus, you must you can measure this cost that you have incurred for development. Then adequate resources must be there, technical feasibility must be there, and it must be expected to be profitable. If all these 6 conditions are met, then you can capitalize development expenditure. You can show it in SOFP. Otherwise, it is treated as a normal expense. Okay, development expenditure, if it's capitalized, it should be amortized over its useful life as soon as commercial production begins. Commercial production begins means it is not starting the production of development this new asset. Okay, commercial production means they are denoting sales. Sales. Whenever the sale of this product or whenever the usage of this asset, if it's a non-current machinery, then whenever we start using this asset, that is commercial production. Okay. Or if this is a new inventory for sales, then sale is the date of commercial production. From that date onwards, you will be amortizing this development expenditure. This is a very important topic from IAS 38. Now we have IAS 37. Based on IAS 37, you have 3 headings: provisions, contingent liabilities, and contingent assets. For provision, you have 3 important criteria to be met. There should be a present obligation. There must be a probable outflow. The term probable have a meaning. We will discuss it. Then the amount must be reliably measured. Okay, we will get a reliable estimate. Got it? So if these 3 conditions are met, in that case, we can recognize a provision in the in the single entity statement. Okay. Let's see how to calculate provision and what are the specific situations. I'm not going in detail. You have 5 specific situations based on creating provisions. When you have legal cost and claims, you will be creating provision based on the probability percentage given. Okay. The amount of provision is based on the estimation. Whatever is the estimated amount given in the question, you just record a provision. The journal entry for provision is, you can just note it, debit, provision expense, and credit, provision liability. Then, when there is decommissioning cost or dismantling cost, you need to calculate the present value as provision. It must be recorded as an asset. Okay, the present value of decommissioning cost becomes part of an asset. It is added to the cost of the asset, and the same present value is recorded as provision liability. Okay, that is decommissioning or dismantling provision. Whenever there is a dismantling provision, on this present value, you will be calculating unwinding cost. Don't forget about unwinding cost. Whenever there is present value, you will be calculating unwinding cost. And this cost will be recorded as finance cost in SOPL. In SOFP, you will be recording the present value of decommissioning cost. And on this present value, you will be calculating unwinding cost. Unwinding cost equal to present value into the rate, the discount rate. That is unwinding cost. And this unwinding cost is taken to SOPL whenever there is a calculation of present value. Then you have 2 more provisions. Warranty provision is there. If an entity sells goods and provides a warranty, then in that case, whatever is the expected value, if your company is providing warranty, you will be expecting somebody to return with asking you for warranty, isn't it? You sold some goods and you are expecting, suppose 10% will be returning, 10% of my total sales will be coming and claiming warranty. If that is your expectation, then based on this 10%, that is probability percentage, into total amount of sales, whatever is your total sales, multiplied by your expected percentage, probability percentage, you will be getting the expected value of warranty provision. And you have restructuring provision. This is important. Based on restructuring provision, you have two additional criteria. Other than the initial three criteria for provision, you have two additional criteria. The first one is there must be a formal detailed plan. So restructuring means you are planning to like what? Restructure or relocate your business, okay, or shut down your business, or you are planning something new to your organization. In that case, a formal detailed plan should be made and the plan must be communicated to the affected employees. If the additional two conditions are met, along with the initial three criteria, probable outflow, present obligation, and reliable estimate. If every 5 criteria is met, then you can record a restructuring provision. Okay. And one more thing that you need to notice, whenever there is a restructuring provision, they will be giving you the values of relocating staff and retraining staff. These will not be part of the provision. You cannot create a provision for relocating staff and retraining staff. All other expenses relating to this restructuring, it will be recorded as provision. Then we have one more provision, that is onerous provision. We will discuss this onerous provision in IFRS 15, revenue. Okay, revenue from contract with customers. Then the next subheading is contingent liability. Contingent liabilities definition is important. You have to go through this definition. It is a possible obligation. Keep in mind, if it's a probable obligation, then it will be treated as a provision. But if it's a possible obligation to make payment, then it will be treated as a contingent liability, and a contingent liability will be disclosed in the disclosure note. It is not a liability. It is not to be shown in SOFP as a liability. It is shown as it is disclosed in the disclosure notes. Okay. Then you have contingent assets. Contingent asset definition also you have to read this. It is a probable asset based on a condition. Okay. So contingent liability is a possible liability based on a condition, and contingent asset is a possible asset based on a condition. Okay. Sorry, probable asset based on a condition. So to summarize these things, I have a table here. If we'll understand the meaning of this remote, possible, probable, and virtually certain. Let's conclude IAS 37 through this table. We have 4 situations. Our first situation is a remote. If the chance of outflow is less than 5%, then it's a remote liability and you will be recording nothing. You just ignore it if it's remote. If the chance of this inflow is less than 5%, if the chance of occurrence is less than 5%, then that is a remote asset and that will also be ignored. Then the second case is possible. When can you say that the occurrence is possible? If the chance of occurrence of an event is between 5% and 50%, we can say that this outflow is contingent liability. Okay. If there is an outflow, expected outflow with percentage between 5 and 50%, then you can call it contingent liability, and contingent liability will be disclosed. If an asset is possible, that is, if the chance of occurrence is between 5 and 50%, if the expected inflow is between 5 and 50%, then you record nothing. Okay. This is based on prudence concept. You call this prudence concept. All possible liabilities will be disclosed and all possible assets will be ignored. Then the third one is probable. Probability is represented by greater than 50%. Okay, if the chance of occurrence is greater than 50%, if it's a liability, then you record it as a provision in SOFP. If it's a right to receive something, then this possible inflow is a contingent asset. Just disclose it. Your last situation is virtually certain. If the chance of occurrence of this inflow or outflow is greater than 95%. For example, a trade payable, you will have to make payment for sure. You have a contractual obligation. So in that case, this is a normal liability in SOFP. And if you have a trade receivable, contractually you will be receiving, it's sure that 95% above confirmed that you will be receiving a payment. In that case, an asset will be recorded for trade receivables. Okay, so these are the 4 situations based on inflow and outflow. If the event chance of occurrence is less than 5%, it's remote. Between 5 and 50%, it's a possible situation. Between 50 and 95%, it's a probable situation. And greater than 95, it's a virtually certain situation. So you need to understand this liability simply means outflow. If you have an outflow, and here if you have an inflow. Got it? So this table is all you need from IAS 37. Any doubts from IAS 37? We have 3 more standards remaining. I'll complete IAS 10 now. And the remaining standards, we will cover it tomorrow along with our rest of the topics. We'll plan accordingly. Okay. Here, as per IAS 10, you have, this is the timeline. Let's say this is from 1st January to 31st December. 1st January is your opening date. And your 31st December is your year end. In that case, you will be preparing statement on this date, on 31st December, isn't it? But after preparation, you will have 2 or 3 months period time for authorization. Okay, the date on which the statement is authorized for issue, the date is, let's say it's 31st March. It's not always 31st March, but let's assume. So after preparation, you had January, February, and March. Only after 3 months, your your statement is getting authorization. From 1st Jan to 31st December, whatever incomes and expense, assets, liabilities, whatever is there, you prepared the statements, but your statement is not yet issued till 31st March. So in between this period, that is from 31st March, so from 31st December to 31st March, during this period, whatever events are occurring, you call it events after reporting date. Okay, so in this period, till 31st March, just 1 second, till 31st March, whatever is the event occurring, my God, I cannot draw. I hope you understand. Okay, so in this period, in between this period, you will be applying IAS 10. IAS 10 rules. You will be having classification as per IAS 10, whether this event is adjusting or non-adjusting. If this is an adjusting event, then you will be including this in the statement that has already been prepared in 31st December. Okay, you will be editing the statement. But if it's a non-adjusting event, then you will be recording this event only in the statement prepared in the next year, in the 31st December of the next year. Okay, so this events after reporting date, reporting period has some specific rules. You need to classify all those events into two, adjusting event and non-adjusting event. If it's an adjusting event, you will be adjusting it in the already prepared statement. If it's a non-adjusting event, you will be carrying it to the next year end. In the next statement only, you will be recording this event. So adjusting event means any event that provide evidence during the year end. As on the preparation date itself, if you had an evidence that something related to this will be happening in the next few months. Okay, for example, you are trapped in a court case, and in this court case, the final decision will be given only in January or February. You know that the court case is running in December 31st, and its final decision came only after January. In that case, this has an evidence with the year-end statement preparation date, isn't it? As on this date, you have some evidence related to this event. So if there is an evidence, then we can say that this is an adjusting event. So all other events which happens out of nowhere, like a theft, a loss by fire, then like what? A normal sale of a machinery. So if any such things happens without an evidence in the year end, in that case, all those events are known as non-adjusting event. And if that non-adjusting event is material, then you will be disclosing this non-adjusting event. Okay, you just have to disclose it. You will not be recording it in the statements. Okay, adjusting event means any event that has an evidence from the year end, from the reporting date. Then non-adjusting event is anything that happens out of nowhere without any evidence. That is IAS 10. You have few examples here. You can go through these examples. If you want, now you can take a screenshot. If you understand the examples, the benefit is if you get a 2-mark question, when you read, if it's like identify which among the following is a non-adjusting event, or identify which among the following is an adjusting event. In that case, if you have these examples in your mind, you can save lots of time. You need not cross-check this evidence thing and all. Okay, so go through these examples. These are the examples of adjusting events, and these are the examples of non-adjusting events. Okay. Priority of chapters and what to do in the last 2 days prior to exam. Priority of chapters, I didn't get it. Like from most important to least important. Is it like that? Well, actually, in financial reporting, you cannot say that something is important. Like every standard, I can say the important standards. Most important standard will be IAS 16, IFRS 9, IFRS 15, and IAS 36. Okay, the remaining small standards is of equal weightage. You can expect any of the standard as an adjustment in your single entity statement preparation. When you're preparing a single entity statement, you can expect an adjustment from any of the standards. Okay, but IFRS 9, IAS 32 is also like, it's not very much important. IAS 38 is Hitanshu, it's like, it's regarding intangible assets, isn't it? If you understand IAS 16, I told that IAS 16 is very important, but compared to IAS 16, IAS 38 is somewhat least relevant. In IAS 38 itself, you have the subtopic research and development. That part is somewhat important. It is usually tested. Then IFRS 9 is very much regularly tested in every ACCA exams, both in FR and SBR. Then you have, just as I said, impairment loss is also regularly tested. Then IFRS 15, revenue from contract with customers. These are all important. Okay, but I cannot give you a weightage like that. If it's like, if you are keeping topics for last, then keep chapter 6 and 7 for last. Then there is a small topic IFRS 13, fair value measurement. That is also not important. So I don't have anything else that you can skip. Okay, everything is important. And for the last 2 days, I want you to relax. Ashyat, got it? That's my plan for your last 2 days. Now you are struggling, isn't it? We have covered almost everything. You have the conceptual knowledge. Now make these days, make use of these days for practicing. And the last 2 days, you just sit and relax. Okay. Before 2 days, you have to do a mock exam and be confident for your main exam. But I don't want you to panic and think that there is so many things I won't pass. This is very difficult. Okay, don't panic. Recorded video will be available in the YouTube. I cannot read your name actually. So whoever it is, yes, it will be available in the YouTube. So that's all for today. For tomorrow, I'll sort the things and we will plan accordingly. The essay question solving and all. Got it. We have covered almost all the major standards. Now we only have IFRS 15. We'll do it tomorrow. Then we have IFRS 16, lease, and we have IAS 33 EPS. IAS 33 is something in connection with this interpretation. So when we are teaching this interpretation part, I will give a connection to this IAS 33 and I'll teach you the calculation of IAS 33. So tomorrow we'll cover 3 standards. Then we will solve essay questions as much as possible. Okay. So that's all for today. We have covered the major portions. Thank you so much, Ashyat. Yes, I hope the session was helpful for each and every one of you. Maybe not today, but you can go through the recorded classes for your last moment revision and all. Yes, thank you. Thank you so much, everybody. We'll see you tomorrow. Yeah. Yeah. Bye-bye. Weightage, Shika, what I can do is I will share an Excel in the group. Not in the group. Maybe tomorrow in class itself, I'll be presenting the screen. It's like it's not an actual weightage, but I'll tell you how you have to study. Make sure that these topics are covered. Okay, just now what I told was IAS 16, this is very important. Then IFRS 15 is important. IFRS 9 is important and IAS 36. Regularly for every session, you can expect questions from these topics. Okay, these are the topics, but others are also important. If possible, I'll tell you the weightage. I prefer Kaplan, Ashyat. You can follow Kaplan and make sure that you have covered everything from Kaplan kit. Study Hub, you have so many, like, what I feel is so many local questions. They'll be asking you, like, what are the methods for calculating depreciation? Such questions will not be coming for your ACCA financial reporting exam. So question practice from Study Hub is not preferred. BPP is also like, if after completing Kaplan, you can go for BPP. That is my personal choice. Okay. And it's up to you. You can practice from anywhere. But as for my point, Kaplan kit coverage is more than enough. Okay. Make sure that you understand every concept. Okay, thank you, Shika. Thank you, Ashyat. Oh, sure, Ashyat, you can score it. It's not like you can score 90 plus only if you cover all these materials. It's based on your conceptual knowledge. Okay, even for me, I had so many students, and from my personal experience also, it's not like I practiced every question from this Kaplan and BPP and Study Hub. Whatever I'm learning, I understood. Whatever questions I'm practicing, I was 100% confident. And after that, I also scored high marks. My students also scored high marks. So it's not about which all materials you use. It's about how much you practice and how much you understand this question. Okay. So based on your response, I believe you will be getting higher marks. All the best. Ashiyat, where are you from? Just to know. Yeah, you are from Kerala. Where in Kerala? Kasargod. Okay, nice. Okay. So if you didn't get any Kaplan kit question, what to do. Yes, if you don't get any Kaplan kit question, if you want, you can approach me, you can come to me. Otherwise, you just do one thing, see the reference. First thing you have to do is, you didn't get the correct answer. In the answer key itself, they'll be giving a reasoning. After reading the reasoning also, if you don't get it, you go and refer the relevant topic from the Kaplan textbook. Okay. After that, even after that, you are getting confused, you can come to me, I'll help you. So anyway, nice to meet you all. We'll see you tomorrow. Bye-bye. Yes, thank you. Yes, Ashiyat, I'm also from Kerala. I'm from Palakkad. Glad that you are here. After joining the Finchartered, you are the first person from Kerala to be my student.